are live. What's going on, all seven of you cool kids hanging out in the room? First thing, hey Hamid, hey Izzy. Good to see you guys. Man, Sergio, I'm feeling 1,000 times better. Thank you for that. Um, we have suspicions that the basement in this house is yucky. So I didn't go into it for the entire weekend, relocated my office upstairs, and I'll be darned, I can breathe. It's crazy. You guys better watch out. I'm going to be unstoppable now. Guys, today's Monday, October 27th. I can't believe we're almost through October already. Yucky. Yeah, that's a from the Latin yuccus, icus, meaning not good. Guys, there's no news today, so we're just going to get to work. Friendly reminder, guys, it is, what is it? It is 9 a.m. Eastern. And the market just started, and the week just started, and the day just started, and hey, good afternoon. Well, except for Jen. Jen's way ahead of us. So if any of you guys are worried what's going to happen this afternoon, don't worry about it. Jen's already there, and there doesn't appear to be any trouble. So good job, Jen. Guys, we're going to go through and we're going to look. But it's been, you can predict the future. I love it. I need some lottery numbers from you. We're going to go through and we're going to have some fun, guys. And we're going to do what we do, and we're going to talk about patterns, and just do whatever the indicators tell us to do, because that's really all we can do, right? Can't predict what the market's going to do, but I can speculate on the most likely outcome based on what my indicators say. So we're going to learn how to read charts this morning. And the cool thing is, and one of the things that I'm realizing is, no matter where you are with the software, guys, that refocus on chart reading never seems to be a bad thing. The indicators indicate. Going back to basics never seems to be detrimental to anybody in the room, whether they have been with me for a decade, like some people have, 15 years, or whether you're brand new. Guys, the indicators just do what the indicators do. They react to conditions, and then we learn to read those indicators so that we can appreciate, recognize some advantages, and turn those advantages into a trade. And that's what we do each morning here, guys, is we're just going to read our charts, because 90% of the day is chart reading. 90% of the day is really doing nothing. And it's amazing that you could spend that much time doing nothing and still reach your goals. And guys, usually the people that are the best at doing nothing, those are the people that reach their goals earlier in the day, because they're not fighting against unnecessary losers. So not only will you learn how to take the trades that have the potential to win more than they lose, at the same time, you're learning how to avoid situations that tend to lose more than they win. It's a two-sided coin. You will understand through your chart reading, guys, and I say this without any hesitation. You'll understand where the market is likely to continue. You'll understand where the market is likely to go. You'll understand where the market is likely to stop, guys. And these three concepts that are a byproduct of learning to read your charts are going to be ways to enter where the market is most likely to continue with an underlying trend. It's going to help you manage and take profits at areas where the market is likely to go with your advantages. And most importantly, when you learn these concepts and you understand where the market is likely to stop, you're going to find yourself with an unwillingness to trade directly into those areas, and that's going to help you embrace that 90%. Good morning, Cav. Good to see you this morning. There are three types of trades, guys. And this is straight out of the user guide. And I added this into the PowerPoint because I think it's important to understand that in this room, in the first hour, I talk about a high probability trade, guys. I talk about a trade where all indicators on all charts agree with the rules for the trade. This is the best of the best. This is the highest probability. This is the trade that's going to teach you to read your indicators, guys. This is the trade that's going to help you develop some confidence in the methodology. This is the trade that can be proven with a little bit of study, to win more than it loses, typically 70 to 80% of the time. And this is the trade, because we focus on the best of the best collectively here, it opens the door for the medium probability trade. And the medium probability trade means that most of your indicators align, but a small issue exists. One advantage will be gone, guys, and leaving it to only one increases the likelihood of success. Medium probability trades will be probably the majority of your trades. Trading with a little hitch that isn't supporting the trade, and then because of your ability to read indicators, being able to manage that, being able to take quicker profits, get to zero loss levels, guys, and it's as a byproduct of what you learn in the high probability. And then you will also be able to recognize when you're in a low probability scenario. And this is where I have to remind users, I'm not here to tell you when to enter or when to exit. I'm not here to be the trade police. I'm not here to tell you that you're doing it wrong, because it might be right for you. But I can tell you that when you enter your low probability trades, because multiple advantages are gone, guys, you've got to enter that trade with the expectation that you're probably going to lose more than you win. And just, I'm not, I don't know what the word is, but that seems like a horrible trading plan to me. To actually enter a trade and say, well, this one's got a better chance of losing than winning. Let's see what happens. That seems pretty reckless on your investments. But again, decisions that you'll have to make. We're going to learn the trigger line and Fibonacci rules, guys. I'm going to go through rules for two different platforms. We're going to talk about NinjaTrader. We're going to talk about TradingView. We're going to go through the rules. I'm going to hand you plans. You will have a plan for NinjaTrader called the KISS plan, keeping it simple. It's a stepping stone. It's designed to optimize your chances of success so that you learn to read the indicators. And I'm going to hand you a plan for TradingView. And it is a stepping stone in your learning journey. It is designed to optimize your chances of success as you learn to read the indicators. This is the beginning. This is your foundation. This is not the only way to use the software, guys. But if you simulate, and as you learn this process, guys, there's nothing wrong with being on simulator. Some of you alphas, you egomaniacs, like I may have been, believe that simulation, oh, I can't possibly learn anything on simulation without a skin of the game. And I hear that a lot, and it's just ridiculous to me. Because on that premise, Tiger Woods had nothing to learn on the 1,000 balls that he hit on the driving range every day, and Michael Jordan couldn't possibly have learned anything from standing at the free throw line for hours after practice, shooting ball after ball after ball, refining his skills, guys. So simulators where you get in and you get the reps and you create the muscle memory. If you post pictures in the room, guys, I'm pretty good about not beating you up. I will point out if you make the same mistake repeatedly, I don't mind doing that at all, because my hope is that you find success. But guys, if you post in the room, what happens is you get a private session with me. We look at your advantages, we talk about your entry, we discuss your exit, and the reality is if there is a better way to read your indicators, maybe there's a little mistake being made, we'll talk about it. And if there's a mistake being made in rule adherence, we'll talk about it. And not just talk, guys, you'll be given a fix. Hey, you keep trading into areas that could stop the market. So we'll mention it. We'll bring the elephant in the room to the front, but then we'll talk about how to avoid it. Because avoidable losses are absolute account killers. And then we're going to simplify, guys. Those plans that I just dropped in the room only have two trades on them. Two trades for NinjaTrader, two trades for TradingView. And both of the plans have checklists for entry, guys, and there's only three things on the checklist. That's it, just three. That's where simplicity comes in. I don't need you to learn all the trades as a brand new user. Why not learn the best trade? Why not learn to find success the easiest possible way? And then from there, guys, you're gonna grow. You really will. So if you're on NinjaTrader, there's a spreadsheet was just dropped in the room, guys. In green are the rules for the high probability trend trade. And then in red is your 90% when they're not met. Over 500 pictures of the pattern that I'm about to teach. presented in the room by Nexgen users from all over the world, different walks of life, but the patterns don't know where you're from or what you're doing. They're just patterns. Learn them. Ideas on management, place to build your plan, and then a trade tracking sheet. And then if you are on TradingView, guys, it's the exact same thing. I've got a TradingView journal, trend trades, momentum trades, management, terminations, a place to build your plan, and a tracking sheet. So the path to getting to where you want to be ASAP has been consistent since Nexgen started online education rooms 20 years ago. Post your trades in the room, guys. Open yourself up for a little bit of critique, and then learn the patterns and use those spreadsheets and take lots of pictures. And guys, more importantly, annotate your pictures. Every time you take a picture, start banging away on that keyboard. This is what I saw. This is what I did. This is why I did it. Because the more you tell me about what you were doing, the more helpful I can become. So we're going to begin with Ninja Trader, excuse me. This is the rules for the high probability trend trade, guys. You'll notice that it's only 3. And I actually had a call from a gentleman once. He said, you know what, Mark? 3 rules isn't enough to be a successful trader. To which I lovingly replied, poppycock, it's more than enough. Because these 3 rules each create an advantage. And when you piece these 3 advantages together and let that be your trade, this is a trade that typically wins up to 70 to 80% of the time. And these 3 rules, these 3 advantages, guys, the first 2 are where I really want you to focus. So I say this when I introduce the rules, guys. If you are brand new with me in here, focus on keeping it easy. Only 3 things. Learn how to identify momentum, then learn how to identify a clear path, then learn how to identify an entry, and then you have the recipe for a trade. If you look for a trade before you understand advantages, guys, it's the horse or the cart before the horse. These 3 rules take 2 charts to recognize. Again, a lot of smart people show up to Nexgen. A lot of people want extra indicators. They want more time frames. They want higher time frames, lower time frames. Guys, I'm telling you, you can find an amazing level of success with only 3 rules, and let them happen on just 2 charts. There's a big chart and a small chart. Your large chart is a very slow moving chart, guys. It's a broad stroke of a brush. It shows the overall opinion of the market. And I think this is a great reminder for everyone in the room, no matter where you are with your trading. Because the more you learn how to read your indicators, the more you're going to get sucked into these great looking entries without advantages. So let your large chart define direction and choose to trade with a trend that's already been established. Let the large chart define momentum through rule number 1, and let the large chart show you the areas that could stop the forward progress. And guys, when you lean on that large chart, life tends to be pretty easy. Your small chart is nothing more than an x-ray of the one bar that gives you direction, momentum, and areas. And inside of this bar, when the rules are met for a high probability trend trade, you're going to see a retracement, which is defined as a small move counter to the underlying trend. Your retracement stops at the bottom of that one bar, or starts at the bottom of that one bar. Typically, you'll see that retracement go to an area inside of these triggers. That's your entry. That's typically right at the top of that one bar. And then you'll see continuation in the direction of everything the large chart says. And that's when the market goes down and typically creates the next bar. So this X-ray on a smaller, faster chart allows you to refine that big picture, to pinpoint your entry, to reduce risk, and to maximize profit potential. And we do that because I think it's important to ask who you're trading with and who you're trading against. Guys, no matter how good I get at reading charts, no matter how many contracts I put on, whether it's 5, 10, right, 10, you're feeling like a big deal. These guys don't even know you exist. The large crowd has no idea you're sitting in your room. The large crowd has no idea that you've got 2 contracts or rents due. And what happens is these guys create trends, and these men and women establish momentum. And these folks are the people who react at those key areas that you will know about long before you get there. The small crowd is the small chart. These are the fighters. They create that pullback. And the wonderful thing is that when the rules are met on the large chart, your small crowd typically loses 70 to 80% of the time in their fight. And your rule number 3, your entry rules are defined to pinpoint right where their fight is most likely to be lost. So only 3 rules, only 2 charts, and I want to back it up one more time. And I want to remind you guys that the next 45 minutes is a high probability trend trade scenario, guys. This is going to bore you. You're going to feel shackled. You're going to feel like you're never going to get an opportunity if these 3 rules don't present themselves. Your high probability trend trade is going to open the door for the rest of the trades, and you're going to see way more opportunity, and it's all going to be based on learning to accept that the large chart leads the way, and one entry that's going to help you understand management and profit taking. They happen many times a day, every day. They really do, Victor. But people hate to wait. Both charts will have areas. Areas are horizontal lines on a large chart, guys. It's a divergence high, a divergence low, resistance, support, yellow 1-to-1s. It's a mid-band. Guys, you don't have to know what creates them. Just know the names. And the one thing that I do want you to know is that divergence, every time you hear divergence, I want you to think loss of momentum. So if you see a magenta line from a high pivot, the buyers were in control, the sellers stole their momentum and pushed it down. And the opposite is true from a low. When we're talking about entries, when we're talking about terminations, areas of resistance means that the market is trending up, and it can be divergence highs, Fibonacci resistance, or yellow 1-to-1s. Anytime you hear areas of support, it can be a divergence low, it can be Fibonacci support, it can be yellow 1-to-1s. Sergio, quick question. So I see the pullback did not go inside the window of opportunity. Where did you see that? Are you talking about this picture right here? Oh, okay, so you put a picture. No, it's in there, isn't it, Sergio? So watch this, guys. And Sergio, this is the greatest example of me being a nag where language is important. So I'm gonna push ahead just a second to answer this question. So Sergio, the rules say sell a pullback at an area inside of triggers. Now check this out, Sergio. There's triggers, there are triggers, and there's your areas inside, right where the market bounced. This is the perfect example of a rules-based entry. Does that make sense, Serge? So, guys, this is one of the reasons why the interactive classroom is so important. Because if you ask me a question and there appears to be a misunderstanding of the rules, what happens is we find clarity and when we fix your misunderstanding, and then you get to walk away a better trader. So Sergio, when we go through entries, Swathi, I'm going to repeat it after we talk about the first 2 rules. We'll go through it, and now I know that I need to be a little more specific and a little more direct. So guys, if you'll bear with me through the first 2 rules, we will cover entries until everybody in this room says, absolutely, Mark, that makes sense. Sound fair? Because we're still just learning what the indicators are. We also have trigger lines, and this is going to be important for using entries, guys. There are small triggers and there are large triggers. Small triggers are a fast-moving average. It's 2 solid lines. Large triggers are a slow-moving average. It's 2 dashed lines. You're going to use these trigger lines to define momentum, to define termination conditions, and the large trigger lines are going to help you define entries. So Sergio, it's both large triggers because your small chart has 2 sets. And guys, when I go through entries, I promise I will leave no stone unturned. And I'll make sure that there's a complete understanding. But we're going to break it down because the reality is I don't even look for an entry if I don't understand momentum. Because momentum leads the way. That's rule number 1. And I don't even look for an entry as a brand new user if I don't have a clear path. Rule number 2. So let's go through rule number 1, guys, and make sure everybody's cool with momentum, because momentum is rule number 1 for a reason. On NinjaTrader, if your background is green, you're in an uptrend. If your background is red, you're in a downtrend. It's one of the easiest lessons. And Strong triggers in an uptrend mean that the small triggers are up and above the large triggers and that there's space. I want you to picture scissors that are open. And when the blades separate, you can cut, guys. So it's that gap between small and large. It lets me know that the odds are favorable for the market to continue up. When the smalls are below the large, when there's space between the two, when my scissors are open, guys, this is when the odds are favorable for the market to continue down. Rule number one is defined by one singular look: separation between the small and large. This is strong triggers. And strong triggers has nothing to do with these bars. And strong triggers will have nothing to do with areas, guys. Strong triggers is simply a separation between small and large. And when there is that separation on your large chart, guys, the market is hard to stop. Well, Swathi, have you ever driven to the store? Watch this. You don't have to answer. So there's our separation, and the strong triggers push. But strong triggers can't last forever. Guys, if they did, the market would never go up and down. The market would only go one direction. So there's a good chance, Swathi, that there was Fibonacci resistance right here. There's a good chance that there was an area there. But since all we're focused on is the trigger look, this is strong up, and they do get reversed. And look what happens. So let's talk about that. Strong triggers up, and then your small triggers start coming down. And you're losing momentum, and it's starting to change, and your large triggers squish, and you're losing momentum, and you're seeing change. But eventually, Swathi, you get strong triggers the other direction. Does that make sense? So you're going to see this. You're going to see reversals in the market. Just because a market is strong right now, well, right now there's nothing going on. But here's a good example. Just because the market is strong here, well, it doesn't mean that it'll be strong forever. It can reverse, and it can give you strength the other direction. And it can give you strength down, maybe bounce, and then give you strength up. So what we're looking for is the most current bar. And in the most current bar, you will know without question whether or not the market has momentum. So let me get rid of my untitled real quick. Close, yes. And on crude oil, and this is only the large chart, does everybody see that the small triggers are up and the large triggers are up? And there's the smallest little gap right there, which means that I have strong triggers. And that's all it takes, is that one bar to let me know that the odds are favorable for the market to continue up. And then the opposite of strong, and Swathi, this is what you'll see very often before reversals, is the weak trigger look, when there's no longer separation between the small and large. And what happens is the momentum is going away, and you will visually see the momentum going away with the small triggers rolling inside. And when you have weak triggers, anything can happen up or down. The market may reverse. Fibonacci areas are more likely to hold. And let me find, I made a picture here. And this is a great example of how throughout, for the green, well, Swathi, we're looking at a very incomplete picture. This is just a picture, and the only thing that we're looking at is rule number one. We're not worried about termination conditions. I'm not worried about anything other than being able to recognize separation as strength. Does that make sense? Because for me, if you can't recognize momentum first, then you're going to have challenges moving forward. So let's just focus on small and large triggers. And you're absolutely right. The market did reverse, because the market does it all day long. And this is another instance, Swathi, where I don't have any areas on the chart, but I want you to see strength pushes, weakness reverses, strength pushes, weakness reverses, strength pushes. And then you get these times where the colors on the triggers don't agree, and there's nothing to do here except wait for the momentum to come back. And this is just an incomplete concept. But if you open up the market and you look at the big picture, what you'll find is that when you have strength, the market tends to push. And even from the middle of nowhere, what you'll see is with weakness, sometimes you get bigger retracements from not hitting something. Sometimes you get reversals. There's that weakness. There's your reversal. So what we're going to do, and I love that you mentioned that, is first we're going to focus on momentum because momentum is hard to stop. It really is. But remember that there are forces in control of the market that are not us. And there are times where even with the strongest triggers ever, Swathi, that market will just reverse. It'll just go the other direction. But because we can identify a methodology, a pattern, if you will, that creates these three advantages, we can have a better chance of the market not simply reversing on us. And this is why I encourage you guys, learn them individually first. Learn how to identify momentum and realize that momentum has nothing to do with reversals, and momentum has nothing to do with Fibonacci, and momentum has nothing to do with price bars. But when there's a separation, the odds are favorable, not guaranteed, but the odds are favorable for the market to push and continue in the direction of the trend. That's our first advantage. So if I look at a live market, I love these lessons when you guys talk about it. If I look at a live market, I can say that my smalls are below the large, that space is in between, and by the rules, by rule number one, I can say this look is a look that can push a trend, that can break an area. This is my advantage of rule one, strong triggers. But then that's only 1/3 of the equation, guys. And we're about to talk about why even with this momentum, I don't have rules met, because that's termination conditions, guys. And it says don't trade into them. And these are areas that could stop the market. And termination conditions are just horizontal lines on a large chart. And the same way, strong triggers isn't guaranteed to push a market in the direction of the trend. These areas are not guaranteed to stop a market. But what I'm going to do is I'm going to give you a recipe. And the recipe is based on about 10,000 pictures and thousands of hours of study. And that recipe is going to say, if you trade into a termination condition, you are more likely to lose than win. The same way, if you trade without the advantage of momentum, the market is more likely to reverse from the middle of nowhere than it is to push. And trading's about probabilities, not guarantees. So we're taking three very recognizable probabilities, and we're going to turn those into a trade. Does that make sense, everybody? And I love it when you guys talk in the class, because what it means is that I get to hear where your brain's at. And my wife, when I taught her to trade, Swathi, when we talk about entries, I was saying one thing that made complete sense to me, and it wasn't until she said, Mark, I just don't know what you're talking about. And I completely changed my whole classroom based on a question. So all of these lines on a large chart can stop the market, could stop the market, might stop the market, but they're not guaranteed. So we're going to come up with a recipe that lets us know when they're most likely to stop the market. And remember, these areas on a large chart, that's where the big crowd, the people in control, are most likely to make decisions. This is where they're most likely to enter, where they're most likely to exit, where they're most likely to fight one another. So to define a termination condition, there is a simple recipe, and it starts with allowing your price bars to get to Fibonacci resistance. And once price reaches the area, I no longer need price. I'm going to look at my trigger lines, and I'm going to say how many trigger lines broke through the area of resistance. Does everybody see that no trigger lines, all of my trigger lines remain below that area of resistance? And even here, where price comes down and reaches support, all of my trigger lines remain above support. So that is the recipe for a termination condition. This is an area, and I love language, guys. This is an area that might create a bounce that results in a loser. This is an area that might break. This is an area that might reverse the market. And the reality, guys, I don't know. I don't know which one it's going to be. I don't know if it's going to bounce. I don't know if it's going to break. I don't know if it's going to reverse. But what I do know is that if price reaches an area and none of the triggers break through that area, I have a higher chance of not losing if I simply don't trade. I have a higher chance of not giving my money away if I take absolutely no trades into that area, because it could create a reversal, right? Just like it did. It could create a big ugly bounce that pulls me out of position. It could just break the way it did here, especially with all that momentum. So again, being that trading is probabilities. What I can say without question is that if price reaches that area and none of my triggers get above it, my life is better not trading into the area. And Swathi, you're absolutely right. The momentum is good. But so far, the areas aren't broken. And remember that momentum is only one rule. And you're about to see why it's so important to have the three rules. Because areas that can stop the market can pull funds right out of your account. But areas do break, Swathi, and what you're looking at in crude oil right now is an area with the potential to break, but not the best look. So we're going to go through and I'm going to show you what it looks like, and this is what it looks like right now. If this area decides to break, it's probably going to look a lot like this. But every time you reach a line, and guys, this is the most important lesson because this is the most broken rule. If price reaches that line and the triggers remain above, no trades into the area. Rule number 3 is not met. There is no clear path. My highest chance of success is to wait for the reaction. Does that make sense, everybody? My highest chance of success is to not enter the market trading directly into an area that can stop the market. If it's going to break, if it's really going to give me the highest chance of finding a trend trade, guys, this is this transition, number 2. When 3 trigger lines, and this is important, we're counting triggers still. When both small triggers and 1 large trigger get below that area of support, with all of that momentum, that area has the potential to break. And guys, on the KISS plan that I gave you, that'll be the second trade that's on the plan. And that trade is based around the momentum and the potential of the area to break, but it's still not a clear path. This will probably be most of your trades, guys, with that potential to break. And I'm going to give you a plan that is repeatable, recognizable, and testable to take advantage of that potential. But until 3 triggers get through, that potential isn't the best potential. And you're more likely to see a fight. But when 4 trigger lines, all 4 trigger lines, both small and both large, get below support, this is when support is broken. This is when the path is clear. You'll actually find that support behaves like resistance when it breaks, and the market gives opportunity because of momentum and path. The first 2 rules are met, then you'll go look for an entry. But until 4 triggers break through, it's not a clear path. It might be the potential and there's a lot of opportunity, but until all 4 triggers get below support, support is still in play, and it could stop the market. So price reaches, where are my triggers? Well, Swathi, that happens, doesn't it? That does happen. Have you heard in the very beginning of class where I say 90% of your day is likely to be doing nothing? 90% of your day. So Swathi, if you spend 6 hours in front of the market today, you might be active for 36 minutes of it. Maybe. Which means that there's going to be a lot of times where you can't seem to get momentum and path to work together. But then again, I'm going to say it again because new users only hear that they can't trade. Once you understand momentum and path, once you get these two concepts, it opens the door for a lot more opportunities. So when I talk about this first hour, what I am really doing is, does everyone, same as I did, have like a grandmother that all she wanted to do is keep you safe? And if you were walking and there was a snake, she stood between you. And if it was a thunderstorm, she put her umbrella over you guys. That's what the KISS plan is. This is the best of the best. This is the highest probability. This is the most outstanding ever. And from this one trade, you're going to begin to recognize more and more opportunities. So no triggers, no trade. 3 triggers through, you got the potential. There's the second trade. And then 4 triggers is the absolute best of the best. Look, and the easiest classes, excuse me, the easiest trades that you'll ever take will have momentum and they'll have a clear path. But they're certainly not the only trades you can take. And even the next one, I love this. And this goes back to, because this was my problem. I would watch the market move and I would be upset that I couldn't get rules met. I would watch the market move and I would be upset that I wasn't in the market. There's going to be times when there's multiple areas and you can't get a clear path. There will be times where the momentum goes away and you can't find your entry. And this is 90% of your day. So much so that I added a slide in here to remind you this is 90% of your day. But guys, the futures markets trade an average of $220 billion hourly. And you don't have to be the first one in. And you don't have to be the last one out. It takes $400 a day to make 6 figures as a day trader. So we're going to learn how to identify the highest chance of success first, so we can avoid, or at least if we enter the market with only the potential to break, we have indications when that trade is more likely to fail. So Swathi, do you see how it's only 2 triggers below? Which means that it's potential, but it's not great potential. And if you took the entry, that blue line right there said, Swathi, that area may not break. It's less likely to break. And this is the plan. This is the plan that I gave you guys. So it's really focusing on advantages, and then we will turn those advantages into a trade. And once you can find the very basic, it just opens doors. So momentum pushes a market. It's hard to stop on that large chart. A clear path means that there's nothing on the large chart to create a bounce, right? Nothing on the large chart that is there, that is identifiable, that can be problematic. And this is the best of the best, but it's not the most often. But if you go back and look, it creates a bounce. And resistance that broke behaved as support, and that creates a bounce. And weakness reverses. And one-to-ones create a bounce, and weakness reverses. And now what you're doing is you're starting to say, okay, these markets trade billions. There's so much movement. Let's go find the best of the best movement so that we can find more eventually. And when I have momentum, and when my path is clear, this is when we'll go to the smaller, faster chart. So guys, we're going to do rock star lessons on the smaller, faster chart real quick. This is where you're going to use a limit order to buy or sell an area, fibs, mid-bands, yellow, one-to-ones, inside of triggers. And when I say inside of triggers, let's go back and find a visual, because I want to show you guys why triggers are so important on the entry. So if I bring up a large chart and a small chart, does everybody see how on the small chart there are 2 sets of large triggers? Swathi, are you telling me the market didn't come to them and fill them, or they're just not filling? So guys, there's the large chart, or the small chart large triggers. And you see that they don't really correlate with the large chart. On your small chart, there is also the synthetics. These are the large chart large triggers. See how they pull over? Even if it comes fast, it's not getting filled. But is it reaching your order, Swathi? and it's not getting filled, I would, without seeing it live, it's difficult to diagnose. Um, and I'm trying to think of an instance where that may happen. If you want to show me a picture, yeah, but whether it's moving fast or not, the only way that it won't fill is because there's nobody on the other side of that trade. So I'm not sure where you were, and with 80,000 people, contracts being traded, it's unlikely. Um, if you'll show me a picture of your chart, I'll do my best to diagnose it for you. But guys, let's talk entries first. There are two sets of large triggers and synthetic triggers. And does everybody see the synthetic triggers? Are the large triggers from the large chart? That's it. We didn't add an indicator. We just superimposed it on the small chart. And guys, this is where accuracy of entry comes into play, because you're going to use a limit order, which means you're going to wait for the market to come to you. Swathi, show me a picture of your chart where you tried to enter. Let's see what happened. And we're going to use it at an area, at a fib, at a midband, or yellow 1-to-1. And that area needs to be inside a trigger. So when you look at it, we're going to wait for the pullback, that little push down. And we're going to wait right at an area, at a fib, at a midband, or yellow 1-to-1. But guys, it's imperative that it's inside of those triggers, because those triggers are moving averages, and price returns to the moving averages. So we're going to use these triggers to define where the market is most likely to retrace. We're going to use the areas inside of triggers to define where the market is most likely to bounce. Is everybody with me on that? So when I say favorable large triggers, I mean that the large and the synthetic, man, they are overlapping, one on top of each other. That's your absolute best look. But a very common look is sometimes they'll be split, they'll be separated. And that separation doesn't negate entry, but what it does is it means that now you have a much larger zone where the market is most likely to retrace. And there's even more space, more areas, more room for fibs, midbands, and yellow 1-to-1s where the market may bounce. So when we talk about entries, and Sergio, this is why that one was a good entry. And we're going to go through the whole thing. That was your question. Did we get it answered? And I think that it's important to remember that these work together to define entry. All about now, right on. So when the large chart says up, and when the large chart has a clear path, this pattern is how you're going to enter the market. And it begins with a reversal bar, guys. And a reversal bar signals the beginning of that pullback. The pullback is the small move going against everything that the large chart says. And you're going to use trigger lines to define where the retracement is most likely to go. And that is somewhere, and Sergio, this is where the language comes in, somewhere from the top of those triggers to the bottom of those triggers. And I don't know where it's going to be. I don't know if it's going to be somewhere up top. I don't know if it's going to make it all the way to the bottom. But I do know, because trading is about patterns that repeat and probabilities, that somewhere from the top of those triggers to the bottom of those triggers, that's where the market's most likely to retrace, where it's most likely to pull back. And then we'll take it a step further. The language says, I need an area inside of triggers, because areas are where the market is most likely to bounce and continue with the large chart advantages. So sometimes there's only one area, sometimes there's multiple areas. And when you say the market is most likely to retrace to the bottom of these triggers, but it's most likely to bounce somewhere at areas inside, creates a window. And again, the window might be 10, 15, 20 ticks wide. It depends on how tight those triggers are, how small the retracement zone is. It creates a window. Your job will be to activate a limit order right at the top of the window, closest to the reversal bar, because remember, your large chart is up and your large chart is strong. And let me show you a great example of why you don't look for an entry until the rules are met. So Does everybody see in this picture? And I'm going to bring this up. And when you're talking about not being able to find your rules met, guys, I want you to see why the rules are in play. Does everybody see the smalls below the large, space between? And rule number 1 is met. There are, in fact, strong triggers. Give me a Y if you see it, please. Because we're about to talk about why there's 3 rules. Nobody sees it? That's okay. Do I need to do a lesson on momentum, or do you guys just not want to talk? Just don't want to talk. Okay. And then here, price reached an area. No triggers through. Even with all that momentum, that's the best momentum ever. But price reaches the area and none of the triggers break, which means that there's absolutely no trades into that area because it's more likely to lose than win. And I want you to see what the market does. It retraces, but rather than bouncing off the areas inside of triggers, it pushes up well beyond the entry. And guys, that is a product of rule number 2, keeping you from taking trades into areas that could stop the market. And that's why we piece them together. Absolutely. So, Swathi, first it's momentum. And this is how my brain goes. And this is every time I look for a trade, the first thing I do, I'm going to go through my thought process. The first thing I do is I ask myself, what direction is the market trading? So is the background red or green? Is it up or down? And here I have a downtrend because it's red. Does that make sense, everybody? Behind the most current bar, the background is red. So that's the first question. The second question, it's like a flow chart. Do I have strong triggers? So I have to go through in a downtrend. The smalls have to be below the large. And there has to be space. And does everybody see? I do, in fact, have strong triggers. That's rule number 1's met. So I'm 1/3 of the way to a trade. My next question is, do I have a clear path? That's rule number 2. And this is where learning this recipe. Did price reach an area? And guys, let me know if you see that price reached a divergence low, price reached yellow 1-to-1s, price reached Fibonacci support, price reached 3 areas. See how the price bars came down and hit it, and hit it, and hit it? Cool. Now I have to ask myself, how many triggers are below that area? Well, my triggers are all the way up here. So my only answer has to be none. And what does that mean? That means it's a termination, no trade short into that area. Does that make sense? It literally tells me, don't take the trade. Don't do it. You're more likely to lose than win. Now let me show you what I did as a brand new user, because I don't mind putting my dirty laundry out there, because I think it's important to hear that until you learn this concept, these entries will suck you into it. So watch this. There's your reversal bar. And if you don't believe in terminations, there's your areas inside of that retracement zone. And very often I see brand new users take this short trade and lose this short trade. And they lost it because they didn't give the respect that is deserved and earned and insisted on through the termination condition. And if you look for a small chart entry, when you don't have large chart advantages, you're more likely to lose the trade. So when you're looking for entries, it's always because there's momentum and path first. And then when it pulls back, you know exactly where it's likely to pull back if it's going to be a winner, somewhere from the top to the bottom of the triggers. And it's most likely to bounce off an area inside of triggers, guys. So this is the perfect recipe for success. And in a downtrend, it's exactly the same. The reversal bar begins. The large and synthetic define where the retracement is most likely to occur, where these up bars are most likely to go up. An area inside defines where the market is most likely to bounce. And your job will be to just activate a limit order just below the lowest point of resistance for a short trade, or just above the highest point of support for a long trade. And now, because you know where the market is most likely to retrace, because you can identify where the market is most likely to bounce, which you also know, and this is amazing, where the trade is most likely to fail. And new users are like, Mark, why would you talk about losers to new users? Because anything that wins 70 to 80% of the time is obligated to lose 20 to 30% of the time. So how do we minimize losses? Well, we minimize losses by not trading in determination conditions. And we minimize losses by insisting on having momentum. And we minimize losses by understanding that when we get to the wrong side of the triggers, beyond the point where the market is most likely to bounce, it's okay to cut ties with that trade. It's okay to take a loser. So first, it's a reversal bar. Triggers define the retracement, areas define the bounce. And your initial stops will be placed about 5 ticks beyond those triggers, guys, because once it gets there, once they get through the retracement zone, once they get past the areas, you don't want to be in that trade anymore. And we go right back to the idea that if a trade, if the basic recipe for a trade is momentum, path, and entry, I have the highest probability trend trade ever. This is a trade that's more likely to win than lose. But once I begin to sacrifice one of those very basic advantages, guys, I have to look at the trade differently. I have to say to myself, this is not the best of the best. I can't expect a trade that's missing advantages to win more than it loses. So this is like the first step in management, is learning where the market is most likely to continue, so you can define where the market is most likely to not go if it's going to be a winner. And the whole thing is a pattern. It's a pattern that's repeatable, that's testable, that's verifiable. So your pattern is first momentum. So without looking at Fibonacci, without looking at an entry, does everybody see the separation between the small and large? This is a market, if all you're doing is looking at the trigger lines, you can say this market is more likely to continue up than it is to go down. That's it. It's not guaranteed, but it is more likely. And then you look at your trigger lines, and there was resistance, and we've got 3 trigger lines above the fib, which means that this trade has the potential to break, but it's not broken yet. I may need to manage. Does that make sense? Doesn't mean don't take the trade. It just means, hey, if you take it, manage it. Be smart with your money. Don't sacrifice any other advantages. And then the pattern is, first it's a reversal bar, pull back to the area inside of triggers, and you were waiting right here. And sure enough, the market launches off into oblivion and goes right to your target. Guys, this is about 70% of the time. 20 to 30% of the time, if the large chart rules are met, it's going to hit your stop. It's going to take you out of the market. It's a cost of doing business, guys. It is a normal part of a positive equity curve. So you can go back and study this, and let's go see if we can find an example. It's always harder on a Monday to find examples. All right, here we go. So first it's momentum. And I'm going to circle the tail on this bar right here. And I'm going to make it the most current bar. So what I'm going to ask you guys is, do you see that the smalls are below the large, that there's space between? Is rule number 1 met on the large chart? You see it? I hope so. That's important. And then the next thing is, guys, the price bar didn't reach, whoops. The price bar didn't reach those yellow 1-to-1s yet. It's close, but they didn't make it. Does everybody see the clear path? First it's momentum, then it's path. You can do whatever you want, Swathi. So once I have momentum and path, watch this. I'm going to scroll back on my smaller, faster chart. And I want you to see where that circle right at the top of the tail ends up. Right at a mid-band inside of the retracement zone. And guys, that's your pattern. And that trade just kept railing down. This is what I talk about every day. Not because it's the only trade. Because this is the trade with the highest chance of winning. This is the trade with the highest chance of success. When I have momentum, when the path is clear, pull back to an area inside of triggers, that's the entry. And it's an entry that's repeatable. And it's an entry that's testable. And Swathi, look at that. Momentum and path. Perfect read. So guys, let's go to the smaller chart. If we got a reversal bar right now, Swathi, great eye on this. Watch this. Before it ever happens, guys, I know if the market pushes down, it's most likely to push somewhere from the top to the bottom of the triggers. Do you guys see it? This is where the language pays dividends. I have momentum. The path is clear. And if I get a reversal bar, somewhere from the top of the triggers to the bottom of the triggers is where it might retrace. But what creates bounces? Areas inside of triggers. So before a reversal bar ever prints, it could be either, Serge. It can be the top to the bottom, but it's the areas within that range. So from the top to the bottom, anything in there that's solid can create a bounce. And before the reversal bar ever prints, guys, you can activate a limit order a tick or two above. And now all we're doing is saying, I sure hope the market comes back to an area inside of triggers because this is where my highest chance of success is. Does that make sense? And Sergio, a lot of people do that. They focus on the large and they miss out on the synthetic. So I'm glad you asked the question. And now we're going to make it even cooler, guys. If I get an entry, I know that my stop goes 4 or 5 ticks below the triggers because that's where the market shouldn't go if it's going to be a winner. And this is what I talk about every morning in this classroom. And so, does everybody see how only 2 triggers made it below support? Only 2 triggers made it below yellow 1-to-1s, and the area never broke. The area never broke because 3 is the best of the best. And what did they do? You had to wait for, oh my gosh, almost 30 minutes. And there's not a lot of movement in the market right now. It is clear, John. Awesome. And guys, it's this one pattern that opens doors for you. It's this one pattern that teaches you to recognize when it's hard to stop a market. And it's this one pattern that gets you in tune with terminations. And it's this one pattern that sets you up for entry. And once you learn this one pattern, everything else seems to jump off the page at you. So when you go to the client trades over here, check it out. This is what's amazing to me. It really is. Does everybody see the momentum on the large chart? Smalls below the large, space between the two. And 3 triggers have made it through support. And what did it do? It pulled right back to an area right inside of those triggers. And guys, this happened in 2022 when the S&P was trading at $3,700. 2022. Does everybody recognize this as the exact same pattern that we just spoke about 3 years ago? In the December contract of the S&P, 2022. So it's not about learning the trade. What it's really about is recognizing that when you have momentum, when 3 triggers are broken through the area, a pullback to an area inside of triggers is your highest chance of success. So the way you do a limit order, Aaron, is when I identify my window, yours is at the price. Okay, So what you need to do, Aaron, is right-click just above the area of support that you want to buy and put buy limit to. So wherever you right-click is where it's going to show up. And you could even right-click down here and put buy limit. And if it's in the wrong spot, click that line, pull it up to where it needs to be, and click it a second time. Does that make sense? Good. Awesome. You're welcome. Shadowpick says, good morning, Mark, and everyone motivated and smart enough to be here learning from the best. I appreciate that. I just passed your my take profit challenge with a single $980 trade this morning, putting me over $9,300, getting me funded with a $150,000 account. Congratulations, Shadowpicks. Big thanks to John and Mark Novak. You are very welcome. The best teachers you will ever have. Thank you. It's your third time in 3 years working and learning from Nexgen. You've struggled with funds, working to support your family. Now my new Nexgen family has shown you the way. Follow the rules, everyone. It's so much easier to listen, follow, and allow the rules to make you profitable. Thank you very much, Obi-Wan, Jedi Trader. Shadow Picks, you're welcome. This is what we do, guys. But I'm going to tell you, I don't make you guys great traders. What I do is I nag you incessantly until you focus on advantages. And Shadowpicks is someone that's been doing this for a couple years. Have you noticed that trading doesn't have to be hard? Have you guys noticed that trading doesn't have to be anxiety-ridden or adrenaline-fueled? When you really lean on the best of the best, it's amazing how calm trading can be. Because it's either rules are met or they're not. You're coming back after a long life-induced hiatus. Sometimes it's much clearer when you look at it now. Yeah. And John, you're not alone. There's a lot of people that come in and rather than look for the best, what they do is they fight and they look for the money. And when you come back, you have this clarity. So John, welcome back, man. And let me know what I can do. So Swathi, you said we could look for an entry, right? And look at that. Here it comes. Are they going to get us? I don't know. But Swathi, you identified the perfect condition on the large chart. We use the language to define where the market is most likely to continue on the small chart. We'll put it 2 ticks above that mid band. So let's see what happens, guys. Let's ride this one out. They either get us or they don't. Swathi, this is your trade. John Tripp, if you go to, here's the website. Like everything you need is right there. You can ask questions in the room. I'll do my best to answer them. But when you go to instructions, it really does start to talk you through everything that you need, registration process. And then any questions you have, I'm not sure who your client advisor is, but you can also reach out to them. You can click at the help button down in the corner, or you can even reach out to me privately with your messaging in Discord. Someone with Nexgen will tell you exactly what you need. And one of the cool things is, John, dig this. You ready? If you've never set up an account with us, grab you a free $50,000 evaluation. But the thing is you do need TradingView to execute. And that's going to be the next platform that we're talking about. But, oh, they didn't get us. Do you guys see how they missed us by 1 tick? And there's a lot of you that say, jump in, Mark, jump in. You got to jump in. Why won't you jump in? They're going without you. Nothing has changed on my large chart. Nothing has changed on my large chart. So Swathi, I go back to the idea that this, without question, without hesitation, this is where my best entry comes from. And if they don't give me my entry, I don't want it. All right, there's our entry. 1, 2, 3, 4, 5 ticks below. And now in the KISS plan, it says, if I get a reversal bar, I will put my stop 2 ticks below that reversal bar. And that's in the plan that I gave you guys. Text and marker, apply. And the plan says if you hit your first target, you'll go break even. Now, what I want you guys to see is because of the entry rules, I hit a $100 target and break even at the exact same time. So if it hits our first target, we'll be break even. Can't use NinjaTrader, John. It's not one of the accepted platforms because of the instability on NinjaTrader. John Novak latched onto TradingView, and because of the outstanding reputation of AMP brokers, he's working in conjunction with them. Now, you can get demos on TradingView, and I teach it every morning. I'm not trying to make you change what you're doing. The concepts are very, very similar. So does everybody see, because of momentum, because of path, pull back to the area inside of triggers, Swathy? So I can't tell you where to put your profit. What I'm doing is I'm using the plan based off of the KISS plan, which says I'm going to take profits at $100 and $200. And if this is a winner, that's a $300 trade. Now, we're at the bottom of the retracement zone, guys. Our stop is where the market shouldn't go. It's 12 ticks per contract. And remember, the perfect entry doesn't guarantee a winner. And it looks like, ooh, we're close. The perfect entry doesn't guarantee a winner. What the perfect entry guarantees is that you have the advantage of momentum, that there's nothing in the way, that you can define where the market is most likely to continue. And guys, there it is. It didn't work. Now, how many of you are like, why would Mark take a trade that loses? Because, my friends, any pattern that you can prove wins 70 to 80% of the time is obligated to lose 20 to 30% of the time. So it's not the wins and losses that I'm worried about, is did I follow my rules? Did I trade the pattern? Did I have the advantages? Is always breaking, we used it before, John? Yeah, that's why John really latched on to TradingView. There's like 100 million users and it's super stable. And man, I'm happy to work with you on it. I'm a fan. I like both. But so without thinking about wins or losses, does everybody see the pattern? 4 to 5 ticks below the triggers, Swathy, because that's where the market shouldn't go. That was $240 loss. That's it. That's not a very big loss. And it's normal. It's going to happen. But when you have momentum, and Swathy, watch this. There's the same look on the large chart, right? Momentum and path, do you see it? Looks exactly 100%. Whoops, come on now. Looks 100% like it did there. So with that circle on there, watch this. If I pull back, there's the pullback to the areas. It never gets below the triggers. And with momentum and path, it does in fact go up. So what you're going to find is that out of these 500 trades, Swathy, and I'm going to show you, I took pictures of the perfect trades and I put them in the study materials, even though the trade failed. Because with momentum and a clear path, you'll know exactly where you shouldn't be in that trade anymore, right where the market shouldn't go. But when you take great entries, no worries, Swathy. Have a great afternoon. Thank you for asking questions this morning. I appreciate it. I hope it gave you a little clarity today. I really do. And we'll keep doing it every day until it's easy for you. That sounds good. So guys, that's your pattern. This is a pattern that typically wins 70 to 80% of the time. It's not the only pattern. It's the best pattern. And then from that pattern, you find more. All right, let's go TradingView. So now we're going to go and change gears. We're going to go to the other platform. Unless there's questions about NinjaTrader, in which case I can pause for a second. We can go back. Don't be shy. Guys, TradingView is different. It's not better. It's not worse. It's just different. And you'll notice, and John, this will be good news for you. that it still has one-to-ones and it still has mid-bands and it still has divergences. But the one thing that we couldn't get on TradingView yet, we've got programmers working on it, is Fibonacci, those Fibonacci areas. So they're, when you say included, Aaron, included, help me out with a full thought there. We don't give you TradingView. You can get a demo on TradingView, but it's not included. The same way NinjaTrader's not included. You can get a demo and practice, but if you want to use their platform, they're going to insist that you pay them for it. You're welcome. And the same is true, guys. These zones, you're not fine. So you've tried everything to buy the chart prime supply and demand, and you're not finding your way out. So you went to chart prime. Let's go through it together. Because guys, that's what these are, supply and demand. And they come from a company called Chart Prime. And Chart Prime supplies these. So if we were going to buy it, let's check it out. If I went to pricing, and all I need is Chart Prime Pro. So as we go through it, organic, if I click on Chart Prime Pro, it asked you for the email. Did you give it your email? I can't do it because I already own it. So you went through this and gave them your email. Okay. And then from email, when you're paying for it, have you already paid for it? Or does the email take you to log in? Here, let me try this. Actually, I think that's what mine is on. I'm working on it, Chart Prime. So did you receive the email that they sent? If not, check your spam box. So try this. Do you have TradingView up? Are you looking at TradingView? Oh, it did it to you too, Caleb. So try a different browser. Okay. So go to your indicators real quick for me, Organic, and go to invite only. Do you see Chart Prime in there? And one of the things you can do as well is get with Jason and Tech. If you see them in there, then you have them. And it's been a while since I've done it, so I don't remember 100% the process. So they're not there. Okay. So let's see if Chart Prime log in. There we go. Right down there, Chart Prime support organic. I would go ahead and type a message in there and see if you can get those answers. Because unfortunately, I don't have access to them. But I would check your spam folder and make sure that everything went through. You're welcome. I'm sorry. That wasn't nearly as helpful as I wished it would have been. Sometimes I just have to divert you guys to the experts. But Chart Prime does the supply and demand. I'm a fan. But Chart Prime is a 15-minute and a 1-minute. And there's a lot of people with Nexgen. They're like, I remember when Nexgen used minute bars. This is nothing new. Your large chart is a 15-minute chart, guys. It's slow. And it will define direction, momentum, key targets, and terminations. And in the plan that I give you, there's a workspace that doesn't even have large triggers, doesn't even have background colors. It's that big. It's that slow. They're just kind of useless. Your 1 minute is your small chart, guys. This is the immediate strength of the market. This defines entry points. And again, it's large crowd, small crowd. People in charge who aren't you, people who aren't in charge but are still bigger and tougher than you. Guys, know who you're trading with. And then because it's such a big slow chart, guys, because it's so hard to see change on a 15-minute bar, because a 15-minute bar, I've seen 100-point spikes. Guys, that is a 15-minute bar from 96 all the way up to 59. 70 points. That's huge, right? How on earth can I trade a bar that huge? Well, there's a way. Let the small triggers define direction. And when the small triggers define direction, what you're doing is you're going with the immediate direction. The market is pushing in the direction of those small triggers. So small triggers, whether they're up or down, is the direction you're looking for rules to be met, either down or up. In this case, most current bar, does everyone see that the triggers are facing up, skyward? And then we blow it up. Because once you define direction, you're going to ask yourself, where's the current price? The highlighted price. Where is that portion of the bar trading in relationship to the triggers? And there's three options. You could be left of the triggers, right of the triggers, or inside of the triggers. And it's the truth whether it's up or down. You can be left of the triggers, you can be right of the triggers, you can be inside of the triggers. And in one bar on the large chart, you can be all three, which is why we look for the most current price. And your most current price will define momentum. And your most current price, guys, that's what's going to help you set up for management using TradingView. So if I'm left of the small triggers, this is the strong side. This is where I say to myself, momentum is the best. It's outstanding, odds favorable, more likely to push in the direction of that trend. This is where 1 minute areas are most likely to break. Not guaranteed to break, but have a better shot. If I'm right of the triggers, that's the weak side of the triggers, guys. And when you guys hear weak, you should get up and walk away, in my opinion, because weak side of the triggers is where reversals come from. Weak side of the triggers doesn't have the strongest push. I'm still looking for long trades, but if I'm below those triggers, to the right side of the triggers in an uptrend, guys, I'm gonna know instantly before I ever enter the market that 1 minute areas are most likely to create a bounce, way more likely than from the strong side. And I'm probably going to get paid right at that area and not hope it breaks. I'll wait for the next trade. And then finally, there's number 2 here. And this is the transition. And it's not quite strong, but it hasn't gone weak. And guys, this is where you really manage those trades, where maybe you'll take partial profits off in an area, but you'll go break even on the second contract. You'll say, man, with the push, with the direction, with the room, I'm going to give the second contract a shot. So when you say the market is going up and I'm on the strong side, you have already lined yourself up for management as well. And then the final question is, do I have room to targets? Most broken rule among traders. Do I have room to targets? You're going to see it a lot this morning. And if the answer is yes, you'll go look for an entry on the 1 minute chart. And if the answer is no, did you guys know that it's okay to not take a trade? If there's no room to make any money, it's okay to not enter the market. But if there is room, we're going to go look for a trade, guys. And there's 2 types of trades. There's trend trades and momentum trades. Those are the only 2 trades on the plan. And both trades have a checklist, and both trades have just 3 rules. So for a trend trade, your large chart can't be trading into areas. If you're following rules and you don't have room to trouble, you should not be entering a trade if you're following this plan. And then it says that your 1 minute is not trading directly into areas. And guys, I'm going to tell you what happens. Your brain will say things like, well, I'm on the strong side of the triggers. I'm going to trade into trouble. Well, there's tons of room over here. I'm going to trade into trouble. And what happens is you get your ass kicked, respectfully, right? Not trading directly into areas. And we all have to learn this lesson the hard way. But if my path is clear on both charts, there's 2 entries, guys. The first one, the trend trade, you're going to buy or sell a close on the correct side of small triggers at an area. And I'm going to show you what it looks like. So when the large chart is up, when you're in the transition side, when there's room to targets, the very moment The second, the instant that your small triggers on your small chart, right there, the moment that they turn down when the large chart says up, your only option is to look lower, looking for an area, looking for a mid-band, looking for a zone, looking for one-to-ones. And you're going to let the market go there because more often than not, when the small triggers roll against you, it goes lower in an uptrend. And when it gets there, this is where NinjaTrader users have trouble. You're not just entering the area. What you're waiting for is an up bar, a reversal bar that closes on the correct side of the triggers, that closes on the weak side of those small triggers against you. And guys, this trade, there will be times where you'll have 10 minutes where you're staring at this area just waiting for them to get there. There's times where you'll have 15 minutes waiting for the perfect trade because these are minute bars. But that close on the correct side of the triggers with an up bar, that's what sets things in motion. And if you look at your small triggers here, the market doesn't come down until it closes on the other side of those small triggers. And sure enough, that's where it starts down. And it hasn't really gone back up. And it comes down and the close above, it starts up, and it pushes down and the close above, it starts up. And guys, that little safeguard keeps you from getting run over. This is your trend trade. This is about 80% of your trades, 90% of your trades. In a downtrend, it's no different. First it's down, then it's strong side, then it's room. Go through that pattern every time you look for a trade. Go through that process. Print out your checklist. Put it in front of you. The moment the small triggers roll against the trade, the moment they go from down to up, your job is to look for areas that are higher, to wait for a down bar that closes on the correct side of the triggers. This is about 80 or 90% of your trades. There are people in this room right now that are passing evaluations with absolutely nothing but trend trades. There's a lot of exciting things to do with the software, guys. Once you understand this trade, you learn to not fight triggers. Once you learn this trade, you learn not to trade into 15-minute areas. Once you learn the trend trade, it sets you up for more trades. The next one is the momentum trade. The momentum trade relies on momentum. You have to have it. If you don't, you can't take a momentum trade. John Novak told me that about 100 times before I believed him. So first, there's nothing in the way. Can't stress that enough, guys. Nothing in the way. The 15-minute has to be on the strong. John, it's like starting over for about a week. True story. I taught NinjaTrader for 5 years, 4.5 years, John. And when we knew we were open the funding company, John says, go get TradingView. Let's write a plan. So what we did, John, and this is pretty cool. And this is one of the things that I absolutely love. Let me get to it real quick. What had happened was in 2004, trade number one, they didn't even call it a trend trade. They said trade number one was a pullback to a midband and a close on the correct side using minute bars. And John, this is a methodology that we've been teaching for decades. And Nexgen's been around for about 30 years. And the ideas are the same, right? The ideas are the same. Wait for a pullback to an area. The only thing that you're going to have to adjust is a little bit of patience to get that down bar. And it's hard for the first couple days. And then you'll try to anticipate closes. That was my big problem, John, is I was like, okay, I know that I have to wait. And John Novak would get in at the area, and I think it was me that said, man, if I just wait to get to the other side, life is so much easier. It will be an adjustment. There's no doubt about it. And you'll have to unlearn a couple things, but the basic concepts are the same. Define momentum path, right? Always start on the large chart. Let the large chart lead the way. Take the time to say, the large chart says up or down. The large chart has this level of momentum. I'm looking for my picture. There you go. And there's nothing in the way. It's just momentum and path. And then it's just finding that next entry. So I'm telling you, I love to teach. And if you want to learn TradingView, we'll do it every day. Guys, your 15-minute has to be on the strong side of triggers. It has to be. If it's not, you don't have the momentum that you need for a momentum trade as a brand new user. You can't follow the checklist if it's not. 1 minute must have strong triggers. That same look that when we talked about NinjaTrader, that separation between the small and large, that gap between the two, you have to have odds favorable momentum. And if you do, this is the only trade that uses a limit order. This is the only trade where you'll actually wait for the market to come back to you. And I got sideways over here. Hold on. I lost my pictures. Totally lost my pictures. Hold on. My goodness. There it is. Haha. My apologies. When I'm on the strong side, when there's nothing in the way, if I have strong triggers, right? It's just if then I'll activate a limit order right at the top of the zone that's already broken. So it's really important, guys, the same way on momentum trades on NinjaTrader. So the strong side, no worries. So let's go back and we'll talk about it. There are 3 places where price can be. And watch this. We can even use the exact same lesson, John, from NinjaTrader. So let me do that, because then it's familiar and you're not looking at something different to get that mental look. Here we go. So when the market is moving in a direction, let me pull up a picture. Small triggers are railing up. So John, if you're left of those triggers, this is the strong side. And that market will never go down from the strong side of the triggers. Do you see it? All the way up. When it works inside, well, now this is transition because it's not quite strong anymore, but it hasn't moved over to the right. So it's transitioning from strong. And then if it goes to the right side, the not left side, that's weak. And one of the things you'll notice, it's pretty cool. And if you're on NinjaTrader, you'll see a lot of people in the room, John, now that you're back, that they just jump into the market with momentum and path. And one of the management rules that we talk about is as long as you are left of those triggers, the market's going up. And it doesn't start to pull back until you get the down bar, the close on the weak side of the triggers. Does that make sense? Do you see it? Stays up, close on the wrong side, there's your push. So we use that idea for trend trades that I don't want to fight against those triggers. But once I get to the other side, to the weak side, it's easy for the market to go with those large chart advantages. Great question. Great question. And then since the strong side is where we have the best momentum, that's where we look for the momentum trade. And we let the market break. And then it pulls back to the area. And this is the only one that we'll use a limit order for. This is a limit order to get into the market right at the zone that used to be resistance, that is now support with all the momentum pushing it. So we do the strong side, weak side first on the large chart to define the momentum of the move, to let us know whether that smaller chart is more likely to break, whether we have to manage it more assertively. And then when we do have strong side, when we do have that familiar look of strong triggers, that's your entry. And this is the only trade that uses limit order. And this is a trade that accounts for maybe 10% of your TradingView trades. And when this trade fails, if this trade fails, if those small triggers turn against and you're not already in the market, then it turns into a trend trade typically. What are the areas on TV? Do you use wicks? I do not use wicks as support and resistance, Big Rat. It's no different. You have one-to-ones, you have mid bands, you have divergence highs and lows, and the difference is these support and resistance. So I don't do supply and demand and use the Wix. I use a company called Chart Prime that provides me supply and demand. And I know that you're familiar with it, Big Rat. If you're on TradingView, there are free versions of it. I think it's worth the 50 bucks a month for Chart Prime. But I'm not using Wix for support and resistance. The wicks are just price movement is all it is. Doesn't play into factor on the plan one bit. So when it's down, when it's strong, when there's room, if it breaks what used to be support, support becomes resistance. And if I have strong triggers, I enter right there. It's a very low risk trade, guys. And what you'll find is that when this chart is good, and there it is right there. If your momentum trade fails, your job is to wait for the trend trade, to make sure that you have room, to make sure that you're on the good side of those triggers, that there's room to make money. And they went a lot lower, and now they're heading up. So there's only two trades, and it doesn't mean that it's the only two trades. It just means that if you start basic, you'll begin to see more patterns. You're going to see that in the second half of class. So I'm going to take like 3 or 4 minutes, guys, and when I come back, I'm going to click on all the charts that have been posted. Um, Remind yourself, please, you're not the trade police. You don't need to be. There's no reason to be. What we're going to do is we're going to talk about advantages on both platforms. We're going to talk about entries. We're going to talk about exit. My job is to help you if you need a little help. So make sure that when you post in my room, guys, if you're on NinjaTrader, you talk about momentum, path, and entry. If you're on TradingView, where's my TradingView picture? Dagnabbit. If you're on TradingView, talk about direction, momentum, and path, and let me know what you see, and I'll talk about what the correct read is if it's not right. So I'll be back in about 5 minutes, guys. Go stretch your legs, get up from your desk for a minute, and I'll see you in just a few. I am back, and we're going to start clicking on pictures. So I'm going to scroll up to the very top of the room, and I'm going to queue up everything that's been posted this morning. And I'm going to say it again. I am not the trade police. I don't want to be the trade police. What I want to do is I want to see what you guys are doing. So, Wayne, are you in the room or are you teaching yoga? I guess if you're teaching yoga, you're not going to tell me you're in the room. Guys, if I ever miss a picture, if you ever have to leave and I need to go back and revisit, just let me know. It's really no big deal. We got nothing but time. We're all young. Almost there. Let's see. Scrolling. There's Pete. There's Victor. All right. Of course there is, John. Here's the cool thing. So if you do TradingView, let me pull it up real quick. Whoops. So there's a full install video under instructions, setting up, TradingView, data connection, everything that you need. It's not that difficult. And once you get it, there's also 100% pre-made workspaces for you here. And even more so in the plan that I give out every day, the KISS plan, there's that super simple NASDAQ, ES. If you're a crude oil trader, you'll find that there's not as much opportunity on the minute bars as there is on the Renko bars with crude oil. But everything that you need, Jason is a rock star. He'll help you with anything you have trouble with. So if you go through the process and you're like, man, I can't seem to figure this out, don't struggle for more than a few minutes. Put in a ticket with Jason and let him take great care of you. And he will. Awesome. And let me know how I can help. All right. What is that line and what does it mean? Sorry I didn't catch this one last night, Wayne. Wayne, that is the VWAP. That is a volume-weighted average price. The VWAP is the floor is lava. I refuse to trade into a VWAP. The institutional users, they see it, they respect it, and the market bounces off of it tons. Like this. So the triggers are down. There's room to trouble. You take the pullback to the zone, and 40917, 917, and you trade directly into trouble in an outer band with the triggers up from a zone, and it works because you had room, it looks like, on the small chart to get back to trouble. Nicely done. And it did. It retested, and then it was party over. Nice trade, Wayne. All right. No room, took quick profit. I'm assuming you went short. I don't even know. Either way, you're right in a zone. And then more trading into zones. And it's hard for me to tell which direction if you're going long or short. Stopped out, got in on the way up away from the zone, and then there's that VWAP that's problematic, and then you get stopped out trading directly into trouble, and then you trade directly into trouble again, and that one got you a little bit of money. It comes from Chart Prime. Thank you, Pablo. It's a company called Chart Prime, John. It's about $50 a month. If while you're evaluating and looking, if you want a version that is free, and I don't think it's bad, I don't think it's as good as Chart Prime, there is a company called Algo Alpha. I'll put the picture in here. That'll give you pretty good idea. Wayne used them for the longest time, and Wayne, I notice that you're on Chart Prime now. So the one thing that you're going to see a lot, guys, is you're going to see trouble, and you're going to die to trade into trouble. You're going to want to trade into trouble, and it works less than it doesn't. And Wayne had to learn that lesson a little bit, and then yeah, the old zone pop up, but with all that momentum going up, make some money, Wayne. And then looks like you tried to go long on the pullback. Triggers up. Quick profits into the zone. Nicely done. And then this bar closed below the zone as it was changing direction, and you go short down to trouble. Nicely done. In above trouble. Oh, I'm sorry. So my apologies, John. So when I talk about zones on TradingView, my bad, I misunderstood the question. So TradingView indicators are almost like 99% the same as NinjaTrader. So there's triggers, which you're familiar with, divergence, which you're familiar with, one-to-ones, which you're familiar with, mid bands, and then it does have outer bands, which are just points of exhaustion. They can behave as support and resistance. They're really just points where the market's gotten so far out it's likely to bounce. It's just a mid band on the outside. And then it's, when I say zones, what I'm referring to, and I don't know if you're familiar with supply and demand concepts, using historical pivots, using historical areas to project forward, very much like Fibonacci does. Because there's not Fibonacci, because it hasn't been able to be automated on this yet, when you see these zones, these support, red and green, what these are is supply and demand. And supply and demand is a way of taking what has happened historically. Let me drop this down. And I could go for hours on supply and demand. But essentially, let me see if I can layman's terms it, is supply and demand takes the idea that there was considerable change or reversals or something right in an impactful area, or even consolidation, and supply and demand comes through and creates these zones. So you can see how it stops. It behaves as resistance, but when it breaks, it comes back and it behaves as support. So what it is it's really just, it's a key area that's been created by market action that's already happened, which is why the market tends to respect it even more. And you can even see on the small chart, there's that momentum look where it breaks above it and then it retests it. Does that make sense? So Fibonacci is a mathematical. Supply and demand is a visual of where it's happened. And it's very effective. And it's kind of our little cheat, since we can't seem to get fibs on it yet. Good stuff. It's let's call it fib-esque. I hate to say that it is fibs because John Novak's built a career for 30 years on Fibonacci. Fibs are exact, right? Fibs are that solid number. You might get zones that are 20 ticks wide, and it creates a little more patience because you're not sure if it's going to go to the bottom or the top. And when you're inside of one of them, very often doing nothing is your best option. Well, we are looking for pullbacks. Oops. We're going to get to a trend trade look. When we do, I'll go through that a little bit. Wayne is very much a jump-in guy. I got you though, John. When everything says down, Wayne uses strong triggers and a pullback to the HVA in the zone. Really fast momentum trade. And what it was is it was the short to the long, or the long to the short. And Wayne, you did this so well. So check it out. First, his triggers were down. He had room to trouble, But because of the momentum on the small chart, Wayne takes a long trade against trend. It's counter trend, but he gets out right at trouble. And then the trend trade entry is the close below those triggers to go down with everything here. Wayne gets in and he does the same thing. So in this trade, he actually took the long and then he exited right where the short was most likely to happen. And then the close on the correct side of the triggers is the entry. And sure enough, it went right down to trouble as anticipated. And there's probably better pictures on the spreadsheet that I give. And Wayne, that was just perfect using the basic momentum. Come back up. But the trend trade entry, there is a pullback. Here we go. Once the small triggers roll against you, you're literally waiting for it to get to an area. That's your pullback. But the entry is the up bar that gets you in on the good side of triggers, on the weak side of the small triggers against you. And your trend trade entry will look the same, no matter what market, no matter where you're at. First, it's a pullback. And instead of getting in at the area, see how it didn't close above, it didn't close above, it didn't close above. But when it finally gets above those small triggers, that's when it starts to go up. That's your trend trade entry. And then the other entry is the momentum entry, which Wayne did. I think I accidentally closed it out with the momentum. But here is that spreadsheet. If you want to burn a couple looks into your mind, that'll help. So we do the limit. No, do not. There is no limit order on a trend trade. So if you're in a trend trade, if the triggers are up, and if I had room, and I'll do this, I'm on simulator, John. The market pulls back to an area. My entry comes from a close on the weak side of these triggers that are down against me. So do you see how I still have 25 seconds before that minute bar is done printing? I'm literally waiting not only for it to close, but it needs to close above those triggers. And I've still got 13 seconds before it happens. So if it's true, I'm going to have my finger on this buy button. 5, 4, 3, 2, 1. And if the rules were met, I would hit buy, and then that would put me into the market. So no limit orders on this particular trade. The rules weren't met, and you can see that it's just going against it quick. But you'll literally wait to mash a button to get in, which I think is cool personally because I'm jumpy, John, and this timer keeps me 100% patient. If it had closed above the triggers, so not just green, but it has to be green and it has to be on the weak side of the small triggers that are down. Because if you don't close above, and this one didn't, look what it did. It pulled right back. And it doesn't mean that the trade's off the table. It just means that I'm not in it yet. And the patience that TradingView provides is pretty awesome. The timer saves my bacon. I'm not going to lie. The timer is a 100% bacon saver for me. We saw this one, Wayne, with the VWAP. And then that was the long to the short. Triggers up, get above, jump in, get out of trouble. From the termination, triggers roll with momentum, jump down, out of trouble. Same one. And then there's that momentum trade. Cool. And please, man, keep asking questions. And John, my email works. While you get up to speed, you're welcome to send me. Like if it's after hours, you're like, man, I'm trying to figure this out. Knock it out. If I'm at the computer, I've got a little OCD. I can't not respond. Momentum trade up. We saw this one. And then beautiful trend trade down, Wayne. Finding your flow. Finding the flow with it. And then here's a great example. When everything is up, even from the weak side, room to trouble. This is where it hits the one-to-ones first. And it is 1, 2, 3, 4, 5, 6 bars until there's a close on the correct side of the triggers, guys. And the bar closes, and because he mashes it at the close, it shows the entry on the next bar. And sure enough, that's where the market goes up, right to the outer band. Victor, absolutely beautiful trade. That is the perfect trend trade. That is the perfect patience and why waiting for the close on the correct side tends to pay dividends. And then Miss Jen, same thing. Everything is up, strong side of the triggers, tons of room. Jen using the outer band because you're outside of the outer band here as well. Close on the correct side, and that's when the market continues up and out break even. So Jen, are you in here? A little management lesson. When you're at extremes like this, when you're out, it's okay to not leave so much on a trade because where you exited, break even, is pretty much where you're hoping the market bounces again, right? So if everything is up and there's nothing in the way, and you're at that extreme where you're outside of outer bands, you can use those closes on the triggers, that bar structure on the triggers, to maybe manage it a little more because the market's at extremes at this point. And if you get 2 down bars on the wrong side of triggers, it's probably pulling down to its next trend trade entry because the market is just it's in space at this point. So you got to use that small chart a little bit to manage those. Nicely done. This is a zone at an outer band. We don't trade when price is in the zone unless you feel invincible. And then the market says you're not. Was this you, Wayne? I'm sorry that you took the losses, but I love that you typed that. Guys, you can have fun with trading. And as you put these lessons into play, one of the greatest things, and I'm going to lift Wayne up real quick, is Wayne always posts in my room. And he asks a lot of questions, and he never hides mistakes. Never hides mistakes. And very often, you'll go back and analyze where your mistake came from. And that's $1,000 worth of losses trading into zones. And that's one of the reasons why that rule is in play. And then this is Paul. Man, I saw this one set up this morning, I think. Down, strong side, clear path. You went long. I'm not sure why you went long. The long to get to the short, but Paul, you didn't even have momentum pushing it, which makes it a little more difficult. But then once you get the short, it's just easy money all the way down. We're all tempted to fight when we get bored. I'm not sure why you took it, right? But you took a long to get to the short, saying, well, and Paul, I don't know if this is where your head was, but if you subscribe to the idea that once these triggers roll up, I have to look higher for my trade. And we say that a lot in here, right? I have to look higher. So if those triggers roll and you're looking higher, Paul, there's got to be a piece of you that says, well, if that's where my trade comes from, maybe there's a way to get to it. You're on the weak side of, or you're on the strong side of up triggers. You know, is it high probability? No, but you kind of reverse engineered the idea that once these roll, this is where your trade comes from. And you just got a little money on the way up. Nicely done. And then the trend trade is just, it's perfect. It's so perfect that even Victor took it. Trend down, strong triggers, room to trouble, close on the correct side of the small. And guys, that's a big one. That's a great looking trade. Nicely done. Nicely done, Victor and Paul. You guys are in cahoots, taking the same trade. And then Wayne says, all you have to do is wait for this bar to close below. And I will respectfully disagree. I will respectfully disagree. This is very much an incomplete thought, guys. And if you believe that all you have to do is wait for a close below, why didn't that one go long, right? Why didn't that trade go up right there? Well, because there's more to it. Um, Strong side, odds favorable, you have a shot if it's a clear path. But guys, this is probably one of the biggest lost trades that I see in the room. The idea that oh, everything says down, I'm just going to jump in, or oh, everything says up, I'm just going to jump in. And guys, it doesn't always work. Making sure that you're on the strong side, so much so that when I saw this one, I took a picture. And I even said there's more to this trade success rate than just the close, guys. Strong side, strong triggers, you have a fighting chance of just jumping in. But once you stray away from one of those, success seems to not happen quite as much. Here's Pete saying, I love this. All the momentum in the world as oil in the afternoon. Everything says down, nothing in the way, odds favorable on the small chart, and Pete just jumps the fudge in. He's below all the trouble on the large chart. He's got nothing but room at fibs. And sure enough, he just rides it down to fibs. And the cool thing is Pete knows that if this trade doesn't go down from somewhere right here, he's still got a trend trade in the cards. This is it's a large chart read of momentum and path and just finding a way. And you guys that are brand new to the software, when you learn momentum and path, you start to find other creative ways to make money. Nicely done, Pete. And I believe this is Paul. 15-minute up, strong, clear path, 1 minute, first profit target filled to not pull stop to +1, +80, -110. So Paul directly into a termination condition, 100%, and I'll be damned, the termination condition held. Thank goodness there were some rowdy buyers that gave you some random weird push high enough to get you paid 80 bucks. You see it? Directly into termination conditions. Guys, that's a hard trade to win. And sure enough, there was a big push that came from that down. This is what we call avoidable losses. But I feel like if you take enough avoidable losses, guys, and I believe this in my heart, if you put yourself out there on simulator, if you're willing to make mistakes, and more importantly, if you're willing to talk about mistakes with me, you'll start making fewer mistakes because you'll just get tired of it. And it becomes very identifiable if you put the time in. Andy V. Triggers are up. They're strong. Tons of room. And you said entry was a little early. 2 lots above trouble. Can I disagree with you, Andy? Oh, I'm going to anyway. This close above, that was your entry right there. It's above the mid band. It's on the weak side of the triggers, and it's somewhere around 46.04. It's about $120 better than where you entered. And what you did is you took kind of the second chance entry, Andy. That was the best one, and it dances. And then it bounces off the mid-band from the other side, the same one that broke over here. And then that's where you get in and you take it right up to trouble, which is absolutely beautiful. But that was a potential entry. This was the next entry. And you got in on what I would consider to be the third potential entry. So rather than a little early, I would say you might have been just a wee bit late. Does that make sense? Those entries lose more than they win? All right. And guys, that's one of the things with, and thank you for saying that. Andy says he's found with gold and silver that this particular entry isn't as effective as waiting just a little bit to get in when there's room. And guys, that is discovering the personality of the market that you trade. And Andy's put more time into gold than I have, and he's put more time into silver than I have. And Andy, if you say it's better when the smalls start to break above the large, I believe you 100%. And it's great patience. And it's a byproduct of Andy V studying the market, looking at the patterns, recognizing what it does, and then finding out when he has an edge, which is everything that we teach every day. Nicely done, Andy V. And I'm learning the nuances of gold by looking through your charts. True story. Like, I'm going to be proficient in gold, and I don't even trade gold. because Andy V is teaching me how to trade gold. And then hopefully when Andy's off doing what he does, we can take some of his lessons to help people out. Rare that it was totally clear to the profit target, but man, it was. Nicely done. Ooh, I see this one. So there's all the momentum. Let's see some prices. 87, 87. All right. There's the tail. There's the pullback. It looks like you're missing a fib, which is weird. But it's all the momentum, and I'm going to say it was probably potential to break. And then there's a pullback to an area inside of triggers, and sure enough, off it goes. Nicely done, Pete. Is that Pete or is that Cav? I think that's Pete. Nicely done. It's just a trend trade. It's amazing how great trend trades are. And Victor, not a spot of annotation. Is this Victor? You said another small one. I don't know what you did, Victor. I don't know why you did it. I see small triggers flat, large triggers down. I don't know whether you went, it looks like you went short, maybe? What is this, Victor? This is Victor going, let's see if Mark's awake and paying attention. I don't have any idea what you did. You have no clue? I see a couple shorts, but I don't see any exits, so I don't know. I don't know. News spike was on notes, focused on charts. There was no news today. Oh, that's Wednesday, October 25th. Wednesday, October 25th. Whose chart is this? It looks like Paul's handwriting. There's the close on the correct side of the triggers. Everything says up, room. And then the news spike gotcha. I'm not sure where that one came from. All right, Pablo, let's see what you did. Small triggers down. Strong side, slightly in transition. I'm going to encourage you guys, let it be one or the other. Let it be strong or let it be transition. Because there are two different management plans based on where price is in relationship to those triggers. So unless I've got both corners to the left side of the triggers, guys, I'm going to call it transition. And the reason I'm going to do that is because it makes more sense to be ready to manage than it does to just hope things break. So we're going to call it transition. Small triggers turn against, rolls right up to the one-to-ones, price closes below, Pablo enters on the close below, should have been in around 8, probably went quick, out at 4, added HVA in the outer band. Beautiful trade, Pablo. And that's almost a $300 trade. Nicely done. Great patience on the entry. Great job waiting for the close on the correct side. Awesome making sure that you had room to trouble. He can be taught. Nicely done, man. Nicely done. All right, let's see what we have here. Aaron. I sold market at 28.85.15. I don't know where 28.85.15 is. 28.80, 288.15, 288. That's 258. 818. I'm so confused. 818. There it is. Got it. Sorry. Took me a second, Aaron. My bad. So you sold it here, hoping that it went down, right? Does that make sense? No, you're okay. It just took me a second. So check it out. Let's go through. You had momentum. Only, I think it's 2 triggers through. Am I seeing that right? 2 triggers through, all the momentum, strong triggers, and you just jump the fudge in. Is that fair? You said, with all this momentum, I'm gonna jump the fudge in and hope it keeps going. And man, I'm not mad at that, Aaron. I think that if you were gonna give it a shot, you gave it a shot. So let's talk about not so much the jumping in and hoping. And I want you to do that. I want you to just for a second understand that hope had a lot to do with that trade. Why? Well, you had momentum, but you only had 2 triggers through. Not the best look for a breakout. So you're relying on momentum, and I think that's not a bad thing. So let's talk about management. You waited long enough past the blue fib on the large chart. I guess I didn't. There was separation of the triggers on the large chart. Also, the small chart, grill me what I did wrong. So you said you thought you waited long enough over here on the large chart. I like that because Aaron, your annotation is doing great things. So let's do this. And you know I have pictures for everything, right? Once price reaches an area, it's the burden of termination is 100% on the triggers. So Aaron, you are in this look right here. 2 triggers through. And when you see 2 triggers through, I want you to say it could break, but it's less likely. Does that make sense? So again, your look's a good look. It's 2 triggers. It is rock star momentum. I can't see where you're coming from. So there are factors that make that area more likely to break. And let me go to the KISS plan that I give you guys for NinjaTrader. Factors that make it more likely to break. First, 3 of the 4 trigger lines, Aaron, is a better look for a breakout, but for the type of trade you took based on momentum, you don't have time for 3 triggers. Fair enough. You're like, I don't have time for 3 triggers because my other triggers are way the heck up here. I don't know. So I think you took a good shot. You got below trouble. You had a ton of momentum. You jump in. So now let's talk about management. And I'm not sure where you got stopped out. Did you get stopped out up here at an area inside of triggers? Did you get stopped out? Okay, exited right there. Cool. So Aaron, I'm not going to tell you, dang it, you did it wrong. What I'm going to tell you is let me give you a couple little tidbits that are going to help you out. So if I take a jump the fudge in trade, and we're just going to call it that, a jump the fudge in trade. And you're going to love this. And you took the perfect entry, man. You took it from over here. As long as price stays to the strong side of the triggers, as long as price stays to the left of these triggers and doesn't give me an up bar, Aaron, that market's going down. Without question, without hesitation. See how it did it the whole way? And when did it start back up? With the close on the correct side. So guys, one of the things you can do on these jump the fudge in trades, and I'm not going to tell you not to take them because there's a lot of people finding a lot of success with them. If momentum is the reason for entry, Aaron, that close on the wrong side of the triggers is a good enough reason for exit for me. Does that make sense? So that would be the first way that I could manage that trade. Now, if I wanted to say it still has the potential to break, once this bar prints, I have to know my trend trade well enough to know that a trend trade comes at a mid-band inside of triggers, right? The high probability trend trade, the best of the best, is an area inside of triggers. Do I want to exit 2 ticks below a mid-band inside of triggers if I'm expecting my jump the fudge in trade to turn into a trend trade? Of course not. That doesn't make sense. So you've got to say, if this fails, are there rules met for another trade? And because there was divergence on the smaller chart, Aaron, it takes that 2 trigger through potential to break right off the table, which says what a great exit. And the large chart look had all the momentum that you needed. And it looks a lot like this. And if I jump in, and gosh, this is beautiful. If I just jump in, do you see how once you get a close, it pushes down and the trade tends to fail? And then pushes down, trade tends to fail. If you just jumped in, that reversal bar, that's where it starts to push down. So you can use that for management. You let the large chart lead the way, right? And once this jump in fails, it turns into a trend trade because of this amazing look. Does that make sense, Aaron? That was a lot of talking. I know that it was. So if all I do is jump the fudge in, reversal bar is a great entry. Momentum's the reason for entry. Loss of momentum's a great reason to exit. If this momentum trade fails with momentum and path, it could turn into a trend trade. So management, it wasn't entry, it was management is where the opportunity lied in that one. Good stuff though. I like it. Good stuff. It looks like I don't even have tick data on here. Let's get all the fibs on for grins. I hope that was helpful. I know that was a lot of talking. It goes into this idea, guys, that I believe, and just because I believe it doesn't make it true. Let me be very clear about that. I believe that if you name your trades, it means that you know the rules that get you into that trade, right? Not knowing it well enough, and that's okay, but this is what we're doing, right? It's the fear of missing out, Aaron. It really is. It's the fear of missing out. When you jump into the trade that isn't your trade, it's just the fear of missing out, and that's okay, and it makes it harder to manage. And hope springs eternal. So I believe if you name your trades, you know the advantages that get you in, right? So if I'm in a high probability trend trade, I know that I've got momentum, path, and entry. If I'm in a 50-50, I know it's only the potential. If I'm in a momentum trade, I know that it's momentum that got me in, which means that you should also have a plan to manage whatever specific trade you're in. I think rather than hope, it was more just not knowing it well enough, and that's okay. So Aaron, a couple things as you go through that. A trade is always first momentum. If you're brand new and looking for consistency, let me rephrase that. Momentum, path, and entry. Momentum you had 100%. Path you were without. And entry you forgot to wait for the pullback to the area inside of triggers. So anytime you look for a trend trade, it's going to look the exact same every time. Does that make sense, Aaron? Every time you look for a high probability trend trade, every time you look for a medium probability trend trade, your entry is going to look exactly the same every time. You can use the exact same words to describe it every time. Pullback to an area inside of triggers. And if you can't describe your entry as a pullback to an area inside of triggers, well, you don't have a trend trade. And even for a momentum trade, as taught by Nexgen, if you didn't break an area and snap back to an area, you don't have a momentum trade. So if all you do is hit sell, you are flying by the seat of your pants. And that's a good way to recognize it. If I hit sell now because I'm afraid it's going to go without me, I'm just hoping that it goes. And I am so guilty of that. I am not throwing stones. Good lesson there. But guys, this is why the fewer trades you take, when you insist on the patterns, you really start to know this is what it's going to take to get me in. This is what it's going to take to get me out. I know exactly what I'm going to do long before I do it. All right, downtrend. I agree. Pull back, and I entered, made some money. Awesome. What did you pull back to? So I'm not sure what market this is. Organic, can we talk? Let's talk. Watch this. That's gold. Okay. So you were in at 507, which is about right here. So one of the things that I encourage new users to do, and this, for the sake of consistency, is you will say smalls down, define your trend, transition, define your momentum, and you have room to those one-to-ones. You've defined your path. Do you see it the way I see it? Down, transition, room to those one-to-ones. That's a good look, isn't it? Cool. So watch this. This is, again, where language pays dividends. And I don't know what you were doing. You might have been walking the dog, whatever. Or maybe you weren't sure if there was a trade. So I'm going to go through the rules for the trade, organic. Because the small triggers roll up, I have to look higher for an area to enter. Does that make sense? Because the small triggers roll up, I know that my trade will either come from these one-to-ones or these one-to-ones or this zone up here. I don't know which one it's going to be. But I do know that my entry says close on correct side of smalls for entry. So the moment those roll, I say to myself, not only do I want to pull to an area, but when I get there, if I get that 32 flavors of awesome look, that's my entry for a trend trade. So there's your trend trade entry. And then what you did, organic, is you kind of just jump in right in the middle with everything down. It's not a pullback to an area, right? It's not a close on the correct side of triggers because you're already with down triggers. So when we look at stuff like this, I just want to make sure that you understand this was your best entry. This was kind of the continuation of that entry. But because you did such a good job of recognizing the potential target, you absolutely nailed it. I love everything about it. You're not fighting anything. You've got room to troubles. Everything says down. The expectation is there. All I can say is you might have made a little more money with the trend trade entry. Great trade. Does that make sense? And let's see if we can, I can't see what the prices are, but if you're in at 057, you might have got an extra 100 or 200 bucks on that one. You're good. It's not even that I am. I just know the rules. And guys, when you know the rules, you call your shots. When you know the rules, you demand the market give you what you need. And the other part of it is when you know the rules and more importantly, you trust your rules, you don't hesitate right here. There is no indecision. You say, with this down and nothing in the way, that is where my trade comes from. And it's less risk and it's manageable risk and it's just more room to trouble. Great trade though. I like everything about it. All right. Adam P., let's talk management. And let's do it in two ways. Adam P., are you with me? Okay, so this was an automation fill. Cool. Adam P., are you in here? I love it, man. So when Adam P. says it's an automation fill, because of the divergence, because of the strong triggers, because of the potential break, your software puts you into a trade. I like it. It's a good look. It really is. And then it gives you a reversal bar. So if you were going to do some small chart management, tick or two above that reversal bar is a good look. The other side of it, and let's use the language, Adam, that gets us into the market. When the reversal bar prints, the market may retrace somewhere from the bottom of these triggers to the top of the triggers. Do you see it? It's a pretty big gap. Until it gets above those triggers, it's still right where it needs to be. It really is. As long as it stays in that retracement zone, it's right where we anticipate it may go. Does that make sense? So it could go somewhere from the bottom, and it could go all the way to the top. And as long as it doesn't get past the top, life is pretty good. Now, if you are going to incorporate the idea that divergence kills the potential to break more often than it doesn't, when you take this trade and you manage it and it comes down, that higher divergence right here, Adam, is a great management opportunity. You got out a little earlier, but that would be the one with this look from that top with that divergence. That higher divergence there would be an awesome exit condition because it never gets where the market shouldn't go. Does that make sense? And there's other people, when I'm trading discretionary, Adam, 2 divergences for me with only 2 triggers through is enough for me to not want to be in that trade anymore. That's just me, my personal, because I'm seeing 2 losses of momentum and I've only got 2 triggers through. It's a great looking entry, and because of this strong top, it's more likely to go down. So if I were going to keep this one, my stop really has to stay where the market shouldn't go. But that third divergence would be a good exit unless I get a reversal bar down right here with the triggers down. Then it's a continuation look to carry more down. I think that you did a good job managing it. I think you recognize change happening. And on the NASDAQ, it happens fast. So good job. And the cool thing is because you're taking these pictures, and let me back it up real quick. Because you're taking these pictures, because of the higher pivot, do I just trail the retracement bar? And you could trail the reversal bar. Why did you put your stop there? And you don't have to tell me. But if you do this, answer the why. And the answer could be, I put my stop here because it already started down. And if it goes higher, I don't want it. And that's a great reason, right? And then if you write that, you know why you're doing what you're doing. And then if you throw, so what happened next, right? Did it go down from right here where it pulled back to the triggers and continue down? It did continue up. Perfect. Higher divergence. I love everything about it. You had a reason to do it. But if you take the time to write that out, your management plan can be consistent. Your management plan can be, if I see this, then I'll do that. And until something else changes, I'm just managing my trade. And as long as you're cool with whatever happens after your exit, and I can tell you, I've taken exits that the market after I get out goes miles in the direction that I was in it, and your brain goes, change your plan. But that consistency, nicely done, Adam. Nicely done. Having a reason, guys, having a reason is everything. And you did a good job of having reasons. It's when you fly by the seat of your pants. My seat of the pants are very, very inaccurate. All right, I did not take this since in a zone. However, 15-minute up, trans clear path, 1 minute potential long into a zone, didn't enter. We'll wait for another setup that is synced with the 15-minute. Nothing for now. I wanted to enter badly, but you chose not to, right? Because your rules weren't met, Paul? And it's 72.50. And at 72.50, you had all of 3 ticks to get to trouble here too. And this is exactly what I was talking about, Adam. There'll be times where your rules say no, and it does this on you. And all you can do is say, well, it wasn't my trade. It must not be my money. And you got to resist that temptation to pine about what didn't fit your plan. Because with all the triggers down from transition, no room, it's so likely to bounce and do exactly what it did right here. Right? And Paul, if you took that same look right here, you lost. So it's probabilities. Good stuff. Great restraint, and I know that's hard. And Victor said, I'll take it anyway. Trend trade, triggers up, price on the weak side. Must manage assertively, nothing but blue skies until you come to his entry. And then it has absolutely nowhere to go. Trading directly into a termination. Hit first profit target at trouble area, move stop loss above entry, waited to hit second. So from 72 flat, you had $40 worth of profit potential. And this is the cool thing, guys. Everybody's different. Paul says, I don't want to take a trade with $40 profit potential from the transition side into an area that already held. Victor says, I'll give it a go. Let's see what happens. And it hit, right? And you made money, and that's awesome. And you made more money, and that's awesome. Does this one win more than it loses? That's what I ask myself. Does trading into the zone, Exhibit A, win more than it loses? It loses more. Do you need that trade to be a successful trader? And I can't answer that for you. I can't answer that for you. I've learned in my own doing that I don't need that trade to be a successful trader. Small's up, they're in transition, and it is above, so there's clear skies up. There's your pullback. There's your entry from 83.25. You've got at least $100 before you hit trouble, Pablo. And so, Pablo, did you do the math? Did you use your box to make sure that you had $100 before it hit something? I love this. Pablo made a box that is 100 points worth. So from 83.25, the close on the correct side of the triggers, you had, it looks like about 6 points, about $120 worth of profit, right? And that's where you got paid because it was transition, 180. It's beautiful. It's awesome. And I love that you didn't want to talk about this one. Didn't post this one in the room because this one makes your guts hurt, right? Up, transition, probably weak side, directly into a termination condition, and you got your ass kicked. And Pablo, I'm going to put you on the spot in front of God and everybody real quick. Pablo didn't present the loser in the room. Pablo annotated and presented the winner because that one makes us feel good. And I can't speak for Pablo, but I did this a lot. Hey, look at how awesome I am. That's the one. You have to hear it, guys. You got to hear. You traded into a termination condition, right? It held. You didn't have any room. And that's exactly what happened. And that's what kept Paul out of that one. And I don't know. I think this is the more important trade. This one's perfect. This one's easy. That one's effortless. We've all done it, Victor. But you got to address it. You've got to talk about it. You've got to annotate it. You've got to lament it just a little bit so you don't do it next time. You got to remember that hurts. You got to remember that that's a kick in the clackers that drains accounts. And the 3 points that you lost here was 3 points that you didn't collect over here, right? Pablo, the one-to-ones which you missed during your entry. All right, hold on. Open up. Links are slow here. There we go. Triggers are down. 95.7. So there's no room. It's directly into one-to-ones at 94. Nope, you've got 17. That's perfect. Market pulls up. Market closes directly into a zone. The large chart was trading directly into the one-to-ones. It was, but from 95.7, you actually had some room to get back. If those one-to-ones at 94, you had $170 worth of profit to get back on the large chart, Pablo. But what you didn't have was even a hint of room on the small chart. Does that make sense? Your large chart was fine, brother. It's this right here that messed up your fun. The exact same way it jacked you up right there. So now we can identify your thing. And guys, every trader has a thing. My thing, Pablo, was exactly what you did. I would trade into areas hoping that they broke. Or I wasn't aware that I was trading into areas. That was really it in the beginning. It's not that I was like, F that area. I was like, oh man, I got so wrapped up in this entry that I forgot to see that. And so now you take a piece of paper and you with that piece of paper, you write in the most delicious crayon that you own, you write down this phrase right here. You ready? So we're about to change your trading. You write down 1 minute not trading directly into something. 1 minute has room. And it's so stinking big that when you go to look for a trade, you say, is the 1 minute trading into an area? And Luna is going to know that that's the wrong thing to do because she's going to hear you say it and then no trade. And we're going to make her a trader too. But that's what I had to do to start beating that habit that I'd created for myself. Because what happened is it worked a couple times is I literally had to say that. And this was on NinjaTrader. I literally had to say, did the market reach an area? Yes. Where are my triggers? They didn't break. I have to stop taking that trade because I would take this trade right here at the area inside of triggers and get run over. And I would be so angry at the market for taking my money. And it wasn't until John Novak just kept knocking into my head, Mark, how many times are you going to trade into lines hoping that it wins? So I love that you shared the loser, man. I know that's not easy to do, but it's an easy fix. Does that make sense, everybody? It's an easy fix. Most challenges that traders face in the beginning are extremely easy fixes. And when you begin to present in the room, when you begin to share, we'll fix them together. That's what I do. I fix stuff. Conversations fix everything. Up, 15-minute in transition. There's your entry at 88. No room to go. And didn't take it. I like it. So Paul's starting to feel the frustration. Paul's starting to feel that, dang it, I can't seem to get a clear path. Right? And Paul, billions hourly. I feel like you're going to find one. I like your odds of finding a trade. Room, transition. Jen, there's your pullback. There's your close above. And same thing. It's super tight. 2 contracts at 80 bucks. Stop where the market shouldn't go, 560. Oh, you didn't take it, right? Jen said, why on earth would I make $80 and risk 560? So Paul, thank you for sending Jen a text going, Jen, it's not worth it. That's not how you build a trading empire. And sometimes it's just not your money. Sometimes it's just not our money. But market went up. That's okay. So check this out. It's still up. It's still transition. I still have an area because the small triggers rolled. Wouldn't it be awesome to pull back, right? To get a close on the correct side of the triggers, to have nothing in the way to the promised land. And a lot of the times, guys, it's just not right yet. But it comes. It really does. You remember 8th grade and you broke up with your boyfriend or your girlfriend and you're like, oh, I'm so sad. It was going to be forever. And then your parents say, sweetie, it's like buses. Another one will come along, right? Guys, that's your sweetie. It's like buses moment. And look at this. They're trying to come back for us. And we'll see if they do. They might. And Jen, you're right. This is where you start breaking rules because you start saying, I knew it was going to break that area, even though it didn't have the momentum. I knew it was going to go for a thought. You didn't, guys. You don't know anything. Stop pretending that you do. You're absolutely right, Jen. There is nothing more frustrating than saying, I knew that area was going to break. With all of that momentum, guys, I knew that area was going to break. Oh, crap. No, it didn't. But that's okay because now I have momentum. My midband's not a termination condition. And I've got an area inside of triggers. Reload it, Victor. I would say reload it or drop a new one in. Where's my TV Kiss plan? I think I accidentally closed it. Let me get it for you. What am I doing? Save. There we go. You could try reloading it. They showed up after the reload? Okay, cool. Oh, they almost got me. But guys, you didn't get this trade because your rules weren't met. But what did it do? It turned around and it's given another opportunity, and it may not get us. But the market does this all day long, back and forth. This isn't your trade, but hang on. We might come back for you. And now they're coming back for us, right? And now I have small triggers up, transition. We're pulling back to the area. And guys, this is where I will literally hope the market slides a little bit and those small triggers keep coming down. Because if they pull all the way down to these one-to-ones and the small triggers are right here, my close above is everything perfect. And right now I've got one-to-ones right here. So I don't have any room up. And I've got 25 seconds to think about it. So let's see what happens. We'll just watch it. Small triggers are down. It's a patience game all week, all month, all year. 90% of your day is just doing nothing. And it's so hard to accept that. All right, look at this though. Now the small triggers are lower. I love that. You've never heard that before. But you can't live the rest of your life like that, right? You can't live the rest of your life doing nothing. And we're taught that we have to be active and we have to be busy. And if we're not in this trade right now, we're never going to be in that trade. We're never going to make any money. The NASDAQ is going to magically stop and there will never be another trade. So now we start figuring out if I got to close above at 96, I've got $60 worth of profit to the one-to-ones. Does that make sense? If I got to close above right here at 96.50, my first sign of trouble is 99. Some of you are cool with it. Some of you don't want it. And then they do that nonsense, right? And then they do that nonsense. And you're like, dang it. Let's see if those one-to-ones stop the market. Let's see if not having room to targets messes with us here. It might not. I never know. I know that I've lost more trades into one-to-ones than I've won. Is anyone else like me on that one? Have you lost more into one-to-ones than you've won? So what's the expectation? If this trend trade we're going to win, we're looking for an outer band, right? Probably looking for an outer band. So if they close above trouble, you guys want to do a science experiment? Yeah, for sure. Oh, look at that. The one-to-one's held and pushed a down bar. We've already had rules met, but there's something in the way. If it closed above with the triggers up, could you take like the second entry for a potential trend trade? Does that make sense? Gary, good to see you. Been a long time. If they close somewhere around 900, but look what it's doing. That second rule on your checklist, guys. Been hanging with AL? Right on. Isn't it cool that you know where the areas are that could create bounces, that could mess things up? Oh man, I'm missing large triggers on my small chart. I'm going to reload real quick. There's my large triggers. All right. So there was my close above. Some of you will say, you know what? I'll take that close above. I'll put my stop below the bar that closed above. It's just a trend trade. Let me go with some trend trade expectations, right? A little bit of patience. Because this was the entry, but it didn't have room. That's the continuation that broke above trouble. Hell, if you were a little bit of a miser, you could reduce risk and say, man, if they get back below the small triggers, it's probably not my trade. And I don't know if this one's going to go, but I know that instead of trading into an area, I'm trading with a close above the area. And the expectation for a trend trade is clearly defined. And into a divergence high, hell, you could even go break even and say they either go or they don't. Who cares? Let's see what happens. But you see how that little bit of patience keeps you from panicking? You could take profits halfway up. Where did we get in? 01? 06 is $100 up, but they got us out. But that's kind of that progression, guys. That progression is like, okay, this one isn't right. If I'm going to try it, here's where I'm going to try it from. And you can create your own plan based on your understanding of the entries, I guess is what I'm saying here. Oh, I guess I canceled my order, but that sure was a good trend trade, wasn't it? Down it goes. Guys, what do you want to talk about? We got about 15 or 20 minutes. Does everybody recognize this pattern? With momentum, mid-band's not a termination. The market pulled right back to an area inside of triggers and continued down. If you're on NinjaTrader and you don't understand that pattern yet, guys, you're doing yourself a huge disservice. Huge disservice. Because that's a pattern that typically wins 70 to 80% of the time. True story. For those of you that are new, I'm a little bit of a bookworm. I'm going to share one of my favorite books real quick. How to Commit Financial Suicide. One easy step. Trade against strong triggers. Trade into termination. That was your question this morning, right? Does it have to be big? So can we just kind of revisit it, Sergio? Just for everybody in the room. This retracement is most likely to go somewhere from the bottom to the top of the triggers. So the tighter they are, the smaller that box is, right? The more they spread out, the bigger the box is. But it doesn't change the idea that it could go from somewhere from here to there. We use the retracement idea, Sergio, to put our stop where the market shouldn't go. And any area inside of those triggers, whether it's physically inside of that trigger, whether it's hovering between the two triggers in the zone, whether it's in the area up here, the area in the retracement zone is where a trade originates. And I think that was the question this morning, right? Well, it's not really inside of the triggers, Mark. It's kind of in between the triggers. And I'm glad that you said that, because what it did for me is it reminded me that sometimes I have to go ahead and say it a little differently. From the bottom to the top, this market could have bounced from the mid band or from the fib. It just chose to do the mid band. That was a great question this morning. And guys, when you guys talk in my class, when you show me what you're doing, so when I was showing my wife the trend trade, I would say when the reversal bar prints, sell an area inside. And my wife kept entering on the reversal bar. And I had no idea. She's like, I keep losing. And it wasn't until she posted, well, she probably came up and sat at my computer with me, where I kept seeing her entry right here. And all I had to do was see that one little thing, and we fixed the challenge. And we still have odds favorable momentum. We still have room to trouble. And we still have an area inside of triggers. Do you guys see it? But now, because those triggers are spreading a little bit, the market could retrace somewhere from the bottom of the triggers to the top of the triggers. And if my trade is filled, my stop goes where the market shouldn't, about 5 ticks above the triggers. I've already called my shot before the reversal bar. And Sergio, that's a good example how the area isn't actually inside of the triggers, but it's inside of that retracement zone created by the triggers. Divergence, they tried to push, and now they're pulling back a little bit. And we'll see what they do. All right, there's our reversal bar. We've called our entry. We know where the stop goes. Let's see what happens, just for grins. There we go. We're in. 1, 2, 3, 4, 5. First target at 100. Second target's at 200. And guys, when you grow with the software a little bit, you might say to yourself, this blue line could stop the market. I'll take smaller profits. Or you might say, with all that momentum coming from a termination, I'll put it even lower. I'll take first profits down here at trouble and see if it makes it. And that's up to you. That's management. Once you can define your entries, management becomes easier because great entries create very manageable trades. And now I don't know what's going to happen. I don't know if it's going to win or lose. I don't know if the market's going to go up or down. I can say that the odds are favorable for the market to go down because of the momentum. I can identify right where the market is most likely to go with all that momentum. But it doesn't guarantee a winner, guys. It's just a pattern. It's a pattern that wins more than it loses. Does that make sense, everybody? And until they get out of the retracement zone, I don't sweat it. I don't care. Because I will do the same thing every time. I'll take the same entry every time. So this right here, Sergio. So that's an indicator called order decorator. Let me find it. I've got it somewhere. Let me see if I can find it for you. It's not NinjaTrader or Nexgen. Templates. It might be strategies. I'm looking. Nope, that's not it. Indicators. It's under indicators. I have to find it, but I'll give it to you. NinjaTrader 8. Templates. Indicators. Gemify. I'm looking for it. Let me search. I have a little bit of OCD, so I don't always keep things. Indicators, file folder, Gemify. All right. Almost there. Almost there. It will add the profit where the target is set. Well, it'll just show you how much it's worth. It won't add I mean, you could do the math from 71 to 55 is 160. It just gives you a visual of what the profit is. Guys, look at that. It never got out of the retracement zone. Not yet. We'll see what happens. I've got it, but I'm not exactly sure. It's not letting me zip file it. Gemify Ninja Trader. Trying to find it for you. Let me see if John Novak has it, and if he does, I'll have him drop it in the room. I'm not sure how to get it off of my computer to get it over to you, Sergio. I'm sorry. But does everybody see? First it's momentum, then it's path, then it's pull back to the area inside of triggers. And I'm asking John real quick. Andy, momentum, 3 triggers through. Didn't wait for the pullback to the area. Got in way above. 1 divergence typically hurts it. 2 divergences makes it really bad. 3 divergences, into the game. Nice exit, Andy. 3 divergences, great exit. All right, Miss Swathy. Let's see what you did. So you had momentum, did not have a clear path. You ordered at the area inside of triggers, and you got paid. Nicely done. And then you're in at the area inside of triggers. And there's our reversal bar. So 2 ticks above the reversal bar is what the KISS plan. Perfect entries, Swathy. Absolutely perfect entries. Everything that I teach. The first one was perfect. The second one, and it looks like you have a fib that I don't have. So you don't actually have a clear path because of the Fibonacci area. So the first one you took, got out of trouble, absolutely beautiful, but you don't have the clear path. Do you see that Fibonacci area right there? How many triggers have made it below the Fibonacci area? Only 1 line, right? That is a termination condition. Yeah. So you had the perfect entry in all the momentum, 2 out of 3. That's a medium probability trade that did wonderful things. And now we've got no clear path, and we're starting to lose momentum as we pull back. And if we got a second higher divergence, that would be an awesome exit condition. But we've got very little risk. I don't have the same fibs you have, so we might be in a different time zone. I think we are. We're in the different time zone, so you're going to have a little different fibs than I am. But you took the perfect trade and managed it beautifully. And now we're in the less than perfect trade because of the divergence. And you would have to manage it a little more assertively. Does that make sense? But you nailed it. Beautiful. The only thing that you didn't have was a clear path. You did have momentum. Oh, thank you for that, Dima. Sergio, there is the online decorator. Dima just dropped it in the room for you. So now we're waiting to see if they want to go down or they want to go up. The momentum says down. On my chart, the path says down. The entry was perfect. The stop is based on the KISS plan, 2 ticks above the reversal bar. And now it's just up to the market to see what it does. If I had been in yours, Swathy, we'd already be $300 richer with only $160 of risk, and that's outstanding. Nicely done, though. Great entries really, really pay dividends. And yours were perfect. Yours were absolutely perfect. I love it. It's just rinse and repeat. Look at that. Oh my gosh. Never got to close above at an area, and now we're all the way back to the area, and we need a close above triggers, guys. And we'll know in 10 seconds, right? It's up, it's weak, it's room. 3, 2, 1, still not a trade. Swathy, is it easier today than it was a week ago? Is it starting to make a little more sense each and every day? That's my hope. Because it's a lot to take in the beginning. I know that it is. But if you keep trying to do the same thing every day, it really does. It starts to stick. And your chart reads start to happen faster. And your understanding really goes up exponentially. And next thing you know, you're like, oh my gosh, it takes me a half a second to read my charts. It takes me a half a second to identify momentum, to pinpoint my entries, because it's the same look every time, right? Every time, it's the exact same look. John and I used to always say, if you don't know if you have a trade inside of the first 5 seconds, you probably don't have a trade. If you have to use words like but or if or could or might, you probably don't have a trade. And if you start it with I hope, you definitely don't have a trade. But these are all the little cues that we have to look for in ourselves. These are the red flags that we present to ourselves. And when we start listening to our chart reads, that's when we start getting what we need. I'm going to download the Gemify too, just so I have it. And then Sergio, do you want a little help installing it? Because if I'm not mistaken, in order to, oh, look at that. They didn't go where the market shouldn't. When you're in a non-rules-based trade, your stomach hurts? Yeah. My palms sweat. Jen, what I do when I know it's not right, I start doing that and that and that. And I'm like, oh man, well, I hope it wins anyway. I'll just go ahead and put this all the way down here. And oh my gosh, I know it's not the right trade. Let me reduce my risk to a tick, right? And you start fidgeting and you stop looking at the big picture. We all do it. That's what's funny is it's one of those things where, you know, there's two types of people in the room. There's people that that never post losers, or people that say they don't lose, and then there's people that tell the truth. Everybody loses. Everybody takes losses. Everybody makes mistakes. Everybody gets into the market when they shouldn't. Everybody jumps in without momentum. Guys, everybody does it because we're all human, and that's okay. But if you have a conversation about it, oh, thank you for that, Todd. If you have a conversation about it, and I think this is really important, if you say, oh my gosh, I took a trade without momentum. Oh my gosh, I took a trade without a clear path. You're less likely to do it. Guys, the KISS plan says that $200 profit right there at 61, that's your first target in the KISS plan. It hit it, but I was in the wrong spot. And when it hits it, your plan says to go break even, to take all the risk off the trade. It hit us, but didn't fill us. So we'll pretend like it got us where we needed it to be, and we'll take the first one off just for the KISS plan. There we go. And when it hits your $200 profit target, the KISS plan says just go break even. It's either going to run or it's not, right? You've got nothing to lose. You made your money. Relax. What's changed? Well, now my small triggers are going down, right? I love that. I still have momentum and path. Nothing's changed on the large chart. It never got where the market shouldn't go. Why would I panic? I've got nothing to lose. How hard is it to sit in a trade when it's not moving? How hard is it to sit in a trade when you don't know if you're going to win or lose? Guys, it's easy if you studied this pattern and you said this trade wins more than it loses. I could take this trade 100 times and lose 30 of them. But I could take this trade 100 times and win 70 of them. And it's noon. Holy smokes, guys, we made it. Good job. You guys want to see if all that momentum and path carries it to the fib? We'll put one down there. Crude oil gets really slow. After 11 a.m., guys, crude oil gets really slow because they start early. There's a lot of Nexgen users that'll bounce over here to the S&P for the second half of the day. But there's the pattern again. There's the pattern again. Crude oil tends to be pretty mellow after lunch. And you could wait a long time for a rules-based trade. And you could wait even longer for it to go to profits. Are there any questions before I call it a day? You guys did awesome. I'm going to end the YouTube.